as Jonathan mentioned, we're going to be getting into basics, rights and obligations, what options are, different strategies, and how to use them. So if you're new to options, you're in the right spot. You're going to learn a lot today. If you are an options user and you have some level of knowledge already coming into today, some of it will be refresher, but me and Jonathan will have some insights and commentary along the way. Should be something in here for everybody. First, we have a few disclaimers to get through. In our outline for today, Jonathan mentioned volume. We'll take a look at where that is and just how this industry has evolved over time, rights and obligations, setting that foundational level for options education and understanding, and then look at the different strategies at a high level, very basic level, what the risk profiles look like with respect to the two different types of options, which we will describe today, those being calls and puts. Options volume has changed dramatically over the years. Let's look at an annualized number. This goes back to the year 2000. Now, I've been in the market since 97, so I've lived through all of this, going all the way back then. We used to trade in eighths and fractions. When I was on the trading floor, it was 1/8 and 1/16 and 1/4. We changed that into decimalization at the turn of the century, and we started to see volume pick up, bid asks get better, but electronic trading also took over, and we had a nice explosion of growth over those years. Really kind of leveled off here with a few bouts of volatility, increased volatility in the market. We more or less stayed at 4 billion contracts for a number of years through, I believe it was this 2012 through 17 period where the VIX was incredibly low all year long throughout these years, but volumes held steady. And of course, we know what happened in 2020. Nothing to be excited about. The pandemic. There was a lot of us that dealt with some very unfortunate circumstances there. But as people gradually started to take more and more ownership of their portfolio and their financial futures, we also opened up into new demographics. And the pandemic shifted things. People paid attention to their own money more so than before. They took advantage of education, and we did see an explosion of growth over the last several years. We are now closing in on 11 billion contracts here from 2023. And here we are through Q2, end of June 2024, almost at 6 billion already with half the year left to go. So we're going to be back in this range again this year. Of course, there's a number of reasons for this. More investors, more opportunity, people taking control of their own money, access to the markets. This year there's a different element. There is some debate whether or not this year is a function of more market participants or more activity from existing participants. There's more expirations available to you today. You may have heard of 0-day options, or what we most often call here at OIC, just short-dated options, more frequent expiries, triggering more activity back and forth. There's a few different things going on, but Jonathan, I'll turn to you for thoughts here as you've seen the industry change and grow with respect to volume, market participants. You've seen it from a different side of minds. When you look at a chart like this, what kind of things come to your mind?
Yeah, it's validation. This is a tool that you can use, these instruments of options and and we'll talk about their uses that they have, but a lot of it is what we're doing right now, this education and learning that this is something that you have access to. Back in the day, it was really only the institutions that were using these, and we're finding that now getting that access, and as you mentioned, the bid asks coming down, making it easier to trade, the commissions dropping, all of these things happening to create this ability. And that's what you all are here today to do, is to learn a little bit more. And if you find out that this isn't exactly what you need, maybe knowing about it and seeing these things in the news. We'll also show a little sneak peek later on here of our trading app, which has the ability to trade options in there, some updates that went through. So we'll give you a quick little video introduction to see that. So trading options in your pocket. And as you mentioned, the amount of expirations, we'll get to that. It's tough. Part of the difficulty when trading options is all the choices that you have to make. We're going to try to guide you along here. So, Ed, definitely excited to again impart some of this knowledge. My years have been trading and talking to our high net worth and ultra high net worth clients, trading for them in some cases, talking about strategy, and now being on the education side. So I've seen a lot of what works, a lot of what doesn't, a lot of the use cases. I've seen it all, believe me. And so I'll try to impart a little bit of that along the way as well.
Yeah, we certainly will do that. Fun fact before we get into options, we started here in 2000 on this graph. The options industry was launched with exchange listed options back in 1973. Day one of listed options 51 years ago, 911 contracts traded that day. Here in this period of 4 billion annualized, that turns out to be about 16 million a day. So you can see what kind of growth there was there. But earlier this year, and this is after June, I think it was in July when we set a record on a daily volume number, we had over 20 million contracts trade in the first hour of the day. You can think about that. The average daily volume that we were so proud of, 16 million, that was easily eclipsed by a trading day in July in the first hour of the trading day. So you can see where this industry has evolved to over time. Now let's get into options. What are they and how do they work? First, motivations to implement options. As you'll see, the different ways you can put the pieces together. You can facilitate a bullish, bearish, or neutral outlook. This is when it starts to separate from someone who just uses stock. Most often when investors are only stock traders, they're bullish, they're looking to go long stock, sell it at a higher level. It's very easy to understand if they're cautious or neutral. Maybe they're scaling down their position or looking for dividend stocks to get some generated income there. But very clean, very simple to understand what you're doing as a stock trader. When you implement options, you now can have elements of speculation, generating income. This refers to selling options. We'll talk about a lot in the session 2 today. Risk mitigation, being able to acquire stock through options. There's all sorts of different things you can do. I often get asked, well, what's the best strategy? Which one works the most and has a history of having the most profits? Now, that kind of answer does not exist. Option strategies operate like a toolbox. You have to start with a forecast, an objective. Where do you think the stock is going? Why do you think it's going there? What type of time frame might that move occur in? And then you open up your toolbox, which hopefully now or soon will have some option strategies in it. So you can see with more and more opportunities to utilize option strategies, you can get involved in different market positions, in different market circumstances, and hopefully be able to take advantage of those circumstances in ways you otherwise couldn't. So options, there's 2 types of options. You have stocks, they trade on their own exchange, a stock exchange, bids and offers. Shares are trading on stock exchanges. Separate from that entirely are options exchanges. Options are derivatives products. They're not stock, they're not shares, but their price is related to shares. So what are they? There's 2 types. You have call options and you have put options. And investors can buy or sell either one. We'll be breaking apart those 4 sides here in just a couple of minutes, but they can buy or sell calls, they can buy or sell puts. And what it does is, depending on whether they're bought or sold and which one is chosen, it offers the investor the possibility of either buying or selling shares of stock. And that'll become clear to you as we walk through those dynamics here in session 1 today. But buying or selling shares of stock with a few standard elements associated with that. This potential transaction in shares of stock would occur on a quantity of 100 shares. So 100 shares might be bought, 100 shares might be sold. Is it bought or sold? Well, that depends on which option you've chosen and whether you've bought or whether you've sold. That goes for ETFs as well. So now let's break that apart into what the calls and puts specifically mean when you choose to buy or sell either one of those. So first of all, you have rights and obligations, and then you have these synonymous terms. We'll start with call options here first, and we'll walk through buying and selling call options. The buyer is the one who's purchased the call option, also known as the holder, and is also long the options contract. Let me define this term here. Long is most often associated with being long the market. You're bullish. You think the market's going higher, so you're long the market. And short is you're bearish. You think the stocks and the market are going lower, so you're short the market. That definition, of course, is true, but in options, there's another definition. Long means you own the contract. You've purchased it, you own it. It has nothing to do with market direction. So when you're the buyer, you're the holder, and you are long the contract. In the case of calls, if you buy a call option, you pay what it costs, the premium, and now you have purchased the right to buy 100 shares of stock at a particular price called the strike price, and you own this right up until expiration. These details of strike price, what price can I buy the stock at? How long do I have this right? These are detailed in the contract and chosen by the investor. You get to choose. What strike price do I want? How long do I want to own these rights? And of course, the choice of strike and the choice of expiration goes a long way to determine what is this call option going to cost me. If I want the right to buy stock at 60, it's going to cost me more than the right to buy stock at 70, which will cost me more than the right to buy stock at 80. And you can start to see that choosing strike is going to affect the price of the option. Going longer in periods of time costs more as the market digests and incorporates a value for a time duration. The longer the duration, the greater the price of the option will be. Staying with calls. So the buyer is long the option, has the right to purchase stock at the strike price for a certain period of time. The seller is taking the other side of that trade, is short the contract, and has accepted the obligation to sell stock at the strike price during the time frame in exchange for that payment. The buyer pays the seller the option premium, and then these rights and obligations exist on either side. Similarly, the option seller can choose, what strike price do I want? What expiration date do I want? And that flexibility of choice exists partly because there are professionals, market makers, what I used to do for a living, who are making bids and offers on every single option that exists across the board. Market makers, the professional market makers, it is their job to provide liquidity, willing to buy or sell any option and take the other side of your trade. And that gives investors the flexibility to choose which option do I want to buy, which one do I want to sell. You don't have to find the other side. The market makers and the professionals are there to provide it to you. There's call options. Put options start the same way. The put option buyer is the holder. They're long the put contract. They've purchased rights. But in the case of puts, they've purchased the right to sell 100 shares of stock at the strike price anytime until expiration. The put writer, who's short the contract on the other side, is paid premium, and they are now under the obligation to purchase shares of stock at the strike price anytime until expiration. So we're going to break down some of these as we walk through the sessions today. But this is the foundation. This is what sets the basis for any and all option strategies. The combination of buying and selling calls and puts, different strike prices, different expirations, maybe different quantities. This is where the entire universe of option strategies come from. Now, Jonathan, most options users are closing positions. You can buy an option and then sell it to close and get rid of it before expiration. In fact, most options users are doing things like that. But there also is this exercise and assignment element that investors have to understand and realize, even if they never intend to exercise and assign an option, they need to know how that works. So what kind of things do Fidelity clients need to understand that you want to highlight with respect to exercise and assignment?
Yeah, this is probably one of the most important slides you'll see today, I would say, just because of it puts everything out there in terms of some of the terminology that goes into this, and the concept of contracts and how this all plays out. So I'll have some thoughts on that as well. But just real quick, expiration, thinking about assignment, these are the things that you have to realize at the end of the day. There's money at stake here. There is shares at stake. You either have to be, as showing here, on a call, buying shares. So that would be what would be calling exercising. A long call holder or buyer, I'm sorry, is actually exercising to take those shares at the end of the day. And so that they have to pay for those. And what we're really thinking about is the end result of these. So expiration, you do have to call Fidelity to get that pushed through. It will also be an auto exercise at expiration if it is a penny in the money or more. We'll get into what that means. Same thing on the other side. There's this assignment, which sellers or writers have the obligation to deliver, either obligation to buy or obligation to sell. So these sort of terms, we're utilizing a lot of terminology here today, and a lot of things we're throwing at you, and it sounds very contractual by nature. Once you start to kind of get the feel for it, you realize it's just, at the end of the day, a buyer is in charge They're the ones that get to choose when and how something occurs in this contract. The seller taking in premium, they're obligated. They have to do what the contract says, which is either to sell the shares or to buy them, depending on what type of contract there is. And once again, this is about sort of the contract concept. We are shaking hands and saying, as somebody who is a call buyer, the other side of that has to do what? They have to do the opposite. If both of us are entering into a contract together, somebody's giving something, somebody's taking something. Me and you are selling something. I was actually learning about recently the first, in theory, options contract. This guy in 600 BC, Thales of Miletus, apparently, said he had a bullish on the weather on a rainy season, and he said, I think that there's going to be some need for olive presses. He actually goes out, he pays a premium and says, I'm going to lock in the prices currently. Ends up being a rainy season. The olive presses, everybody's demand goes shooting up for them. And he's cornered the market because he's got this call contract in effect, ready to go. He's locked in. He has set a time frame. He has set the amount that he needed, and he was bullish on this activity happening. And so he gets to do what? He gets to call. He gets to call the deliverer and say, hey, it's time, deliver these to me. Puts are the other side of that. We always think of somebody putting something to the other side. So that's selling. I'm delivering something as the buyer. So always really interesting to think about some of the history that goes into these things, but getting this straight, and you have to have this down. This page, you've got to know which side of the market you're on, what you are required to do, either to be buying shares or selling shares at the end of this, who's in charge of that contract. The buyer gets to exercise, seller has the obligation to deliver through assignment. Assignment can happen anytime. It can just sneak up on you out of nowhere. I've seen it happen. So you are required to, in the case of something like a covered call, deliver those shares. We'll get into what that is, what that looks like, the risks and rewards that go into it, but just know some of those basics as we start to dive into these types of trades.
Yeah, good story there. It's always fun to get those stories out there. Yeah, the concept of options goes back centuries. The listed contract that we're talking about today is fungible. And just to repeat that point, exercise and assignment, incredibly important to understand. But investors, particularly new ones, should know when you buy an option, call or put, you don't have to hold it to expiration. You don't have to deal with exercise and assignment. Selling to close an option that you're long is something available to you, so you don't have to deal with shares. Similarly, on the short side, if you write one of these contracts, the call or the put option, you can buy it back to close and get rid of your obligation if you choose to do that and not deal with shares and not deal with holding it till expiration. We've mentioned price a few times. The buyers are paying it, the sellers are receiving it. Just to clarify here, so it's a non-refundable payment. It occurs immediately. There's a cash transaction that occurs right away. The buyer pays the seller, who keeps that premium. No matter what happens later, the premium itself is already going to be cleared and in the seller's account. And the dollar amount here, when you look up the bids and the offers and the last traded prices of options, they're quoted on a per share basis. So if you see 300 or $3 as quoted, that doesn't mean $3 in total. Since we are talking about a standard contract delivering 100 shares as its deliverable, that is the official term of the contract standardization, 100 share deliverable. $3 means per share, so multiply that by 100. If an options transaction occurs at $3, that would actually represent $300 paid by the option buyer and received by the option seller. Now let's look a little deeper at those four sides. We're going to focus really on the two buy sides here, and then we'll start with the sell side and continue that sell side in session 2 today. But the buying strategy examples, so buy calls and then buy puts. Why would you buy calls? Well, if you have the right to buy shares at a particular price, that right looks more and more attractive as the stock goes higher. The right to buy shares at 75 looks better as the stock goes from 80 to 85 to 90. It gets more and more valuable. So buying calls is consistent with a bullish outlook on a particular stock. And the choice to use calls often comes attached with a smaller cash outlay than it would cost to buy the shares outright to still be bullish now with a much smaller limited risk. However, since you're buying an option and you're paying something up front, what we'll see here when we look at a hypothetical example is that the stock needs to move further in your favor to be profitable when you're using options as compared to buying the stock outright. Also worth noting, options expire. When you buy stock, you could, in theory, have an indefinite time frame moving forward. You can scale in if it's not working out right. You can do different things without the element of time factoring into your decision and possibly being a limiting factor. With options, there is an expiration. It will be approaching, and there will be the potential need for action as that gets closer. So here's our hypothetical example of buying calls. First, we'll look at the stock position at 140. It's very clean entry. Profits above 140, losses below. That's easy to understand. 100 shares would cost $14,000, and there's your investment. The option, our example here, buying the 140 strike call, gives the buyer the right to purchase stock at 140 up until expiration, which might be a month or two from now. And this option buyer pays, this is $360 for the right to purchase stock at 140 for that limited time frame. So now you can see this chart of the option piece is drawn as if we had already reached expiration. If that were to occur, you can see the stock needs to rally above 140 by an amount enough to pay us back for our option premium amount, yielding a break-even point that is higher than if we just bought the stock. And this is what we mean when we say that the stock needs to move in your favor when you're using options, in your favor, in a direction and of a magnitude and within the timing of the contract in order to be profitable. You do have that smaller limited loss of 360. Stock needs to move in your favor when you're using options, in your favor, in a direction and of a magnitude and within the timing of the contract in order to be profitable. You do have that smaller limited loss of 360 as compared to long stock, but you do have some things to consider on either side of this. Jonathan, what else comes to mind when you talk to people about buying calls, when this comes up, thoughts, considerations, or looking at the chart here?
This is usually where we start, isn't it? Most people understand the concept of buy low, sell high, and that's what we think about when a bullish environment, we're thinking about the stock price or the index or the ETF moving higher, which in this case on this chart is actually moving to the right, our horizontal line there. As price is moving up, you've got this blue line that's climbing. And so you can imagine sort of a Jeep kind of driving up that. It just can keep going and reach as far as it really wants to. There is no technical maximum amount that you can gain in theory. But that is one of the important reasons people start with this. That sort of lures you in to say, great, this thing can keep going and going and going. One of my favorite ever examples is buying a stock and watching it get bought out at a substantial premium and just immediately watching that leverage go to work because there's no limitation here. Just keep going. What you're doing though is you are capping, and if you're putting that Jeep in reverse, you'll see it stops once you get down to that 360. It doesn't keep going. You've got a flat area, which means that is the maximum amount you can lose. And for people who are saying, where do I start? Well, it's usually kind of a good feeling to be like, if I'm wrong, that's okay. Maybe I'm willing to allow this amount to be the maximum that I can lose, and that's okay. I know the risk and I know the reward. As a premium payer for calls, what you are doing, you are spending that premium, and because of the fact that you are limited in the amount you can lose, unlimited in the amount you can gain, that's one of the real enticing facts and reasons why people start with this trade. It's very simple to think about. Make sure that you understand, of course, you see that is the multiplier. We mentioned 100 shares. So it is a $3.60 call. Your max loss then would be that $360. You got to multiply it out. You'll also need to remember there's an expiration here. There's a time that this needs to happen. And so there are factors in terms of how long you may want to hold this, how long it takes. There's nothing worse than being correct in terms of the price moving higher, but it doesn't move far enough. or fast enough. And that's where options can be very tricky, and why a lot of traders get frustrated is that you were correct in terms of the thesis, yes, or maybe that it did rain, but it didn't rain enough to make the olive season and all those work out, so that you didn't get to cash in on that. And that's really where call buying can be important, to think about the risk and reward and the size of your positions. And we'll get into that even more. But this is a great place to start for a lot of you traders. Thinking about that, thinking about the risk reward and the trade and the choosing of your expiration and your strike. That's something we'll be talking about a lot more here today. This is a great place to start.
Yeah, that's absolutely right. And yeah, the limited loss is enticing, but as you said, that the direction of the mood has to be right, but not just the direction, how far it goes, and it has to occur within the time frame of the option. That's what makes call buying tricky, or put buying tricky, to be profitable. I'll just point out for clarification as well that these graphs that we're drawing here, we'll see several of them today. They're drawn as if we've already reached expiration, because we can cleanly calculate what the option value is at expiration. Prior to expiration, this stock might go from 140 up to 143. A day later, after we bought it, it's worth significantly more than 360. We could sell the option. We own it. If it's worth $5 or $6, we could sell it and just get rid of the option piece altogether and not deal with holding it all the way through till expiration. We don't have those graphs of prior to expiration, here's what the option's worth, because that's an uncertainty. Now, the Fidelity platform can help you with that. You can sort of try to estimate, and you can see what type of values might be there. But these types of graphs are cleanly drawn as if we've already reached expiration, and any value associated with time has already been removed. Buying puts is the other one I'm going to talk about here in session one. This is consistent with being bearish on a particular stock. You have the right to sell shares if you buy a put option with a strike price of 45 and the stock goes down from 40 to 35 to 30. The value of selling at 45 becomes more and more valuable. So this is a bearish position looking to capitalize on the stock moving lower. Or puts could be used to protect a position, a stock or an ETF, any underlying that has options, or an entire portfolio of positions. You can use, say, an ETF to protect against a basket of stocks. This motivation here, which we'll look at an example of as well, is you own a stock, you own a portfolio, and you're looking to protect against a big move lower. So you buy a put option, giving you the right to sell the stock or an ETF at that particular price to protect against further losses to the downside. So let's look at each one of these motivations in an example. First, being bearish, looking at stock. This is exactly like buying calls, just flip it over the other way. You're buying the 200 strike here, paying the premium. And if you're bearish, the stock movement has to be of a magnitude below 200 to bring back the option premium of 4 at 196 at expiration. The right to sell stock at 200 is worth $4. That's $4 better than where the stock is. So that becomes your break even. You need that movement from the current level in order to be profitable at expiration. And Jonathan mentioned this in the call discussion. You can lose what you paid. You own an option now. The worst that can happen is that option value goes to 0, and there's your maximum loss. Jonathan, maybe there's a few things different here about puts. You have to consider if you exercise, that looks different than calls. When you think about buying puts, what types of things in contrast to calls come to your mind?
Yeah, we're mirror imaging, right? All of a sudden now we're going to the left, price is dropping, and now we're moving up in value because of that drop in price. That's also enticing for a lot of people, because we've also seen this a lot in the news in terms of shorting and making money when prices down, and a lot of people don't quite understand or don't feel comfortable with it. This is another way to sort of see that as an opportunity to make money on prices dropping, that bearish activity. We always think about, this is maybe morbid to a degree, but the bull sort of running of the bulls. What are they doing? They're usually lifting those guys up in the air, flying them through the air, and the bears sort of again pinning you down on the ground. We always think about these two to keep them straight. Bears down, bulls up. There you go. That's how you kind of can remember when buying which direction you want to be expecting the move to be in. And again, these are more aggressive in terms of their price movement. You want to see that happen. Ed, fantastic clarification. Always important to know this is the final sort of end result. We see this shape. It is actually more of a curvilinear shape, and oftentimes you can see that most traders don't hold this all the way through to that expiration. Most traders will sell or open up a new contract later on in order to add more time if their theory or thesis continues to be correct. So you'll often find that that is not what it looks like, but it's really the only way we can kind of think about it or show it, to make sense to everybody at expiration. So once again, we have those same also thoughts in mind, like limited loss. I can only lose in this case, and this may be very different. Remember, the amount that you're paying, this is a $4 premium. You will find, based off of the type of trade that you're putting in, the underlying security, the time to expiration, that may be 40 cents, that may be 4 cents. It could be anything. And that obviously is a very different amount of loss. But once again, we see that this Jeep now in reverse can keep going up and up and up as price goes down and down and down, with the theory of limitation of $0, which would feel like unlimited profits if you were trading it. So this is a really interesting sort of way to think about that inverse. We starting out with the buyers of contracts, buying a put, buying a call. Remember, these are the two that can exercise the contract. Like you call Fidelity and say, I want to, with a call, buy shares. With a put, I want to sell shares. You are telling us what you want to occur because you paid that premium. We're throwing all of these different types of concepts at you. We're doing a lot of terminology. So that is what you need to be sort of starting out with options, with any sort of new thing that you're learning, right? I'm teaching my kid right now. He's learning about golf. And so we're going in and we're like, okay, well, what does this club do? Well, for this environment, you need this. So we're trying to be your caddies today, Ed and I. We're going to tell you what club to pull out. Again, he also asked me, why does this club cost $1,000 and mine doesn't? That type of thing. We're going to, obviously, each person's going to have very different needs. And that's what we're going to try to learn a little bit about today.
Yeah, we're teaching you about different clubs, what they do and how they work. I like that analogy a lot. And yeah, this opens doors potentially for some investors that might otherwise think, I'm bearish, I'm concerned, so I'm just going to sit out and do nothing, which is a viable choice. But now perhaps an investor who might be aggressively bearish might consider doing something in the options space. We're not going to spend too much time here. I'm going to walk through this quickly, but I at least wanted to have a visual and show what it looks like to have this protective put example. This is a little different. It's got two pieces, and it's actually buying a put while you're bullish, but you already own stock. And maybe you've got a nice gain on it. You're concerned about giving up that gain. You don't want something terrible to happen. So you buy a put option. In this case, we're long stock 120. We buy a put option with a strike price of 100. And what this does is gives us the right to sell the stock that we already own at 100. So no matter what happens, if something terrible occurs and the stock loses 50%, we have the right to sell at 100. It protects us from further losses or further giving up further gains beyond that 100 level. Now we do have a different break-even point because we're spending more money on this position. We bought stock and a put, so out of pocket goes up a little bit, and maximum loss. This is where the benefit comes in. We can now calculate that, knowing we only have exposure to the downside between 120 and $120 plus the added premium. And then we have protection to the downside. This is bullish overall, but cautious and willing to spend some money to protect from a huge loss during the lifetime of the option. That's what protective put is all about. Now, selling strategies, we're going to dive deep in session 2. So this is just a teaser of what's coming. Covered calls is a moderately bullish strategy. Perhaps there's a nice gain on the shares, and investors thinking, well, I've got a target to the upside, but it's getting closer. I'm about ready to sell these shares. What can I do instead of just waiting? And well, selling options, selling call options is a choice here. Being paid money in the form of option premium, being willing to accept the obligation associated with selling shares at a strike price that you choose, bringing in premium along the way, that can add to your bottom line and reduce a little bit of risk in the process. And you can choose whatever options you want, different strikes, different expirations. If you have 1,000 shares, you can sell up to 10 calls maybe sell fewer, maybe stagger them out over different types of options and expirations. A lot of different things you can do. We'll break that apart in session 2. And similarly here on the other side, cash secured puts, selling puts. You can use that to try and make money, or you can be looking for a downturn in the market and use that obligation to buy shares to your advantage, picking up shares below where they're at now and buying the dip. So Jonathan, we're going to get into, while you screen share here, or take over session 1. We're going to get into a lot of this in session 2. We'll be doing a lot more deeper dive in both of these strategies, but I know you wanted to highlight a few things for us today uniquely for your clients on the platform.
Yeah, definitely going to be a big part of that. And then in the next session, we'll talk about more of the selling strategies, the other side of that to be thinking about, and how it's a really unique and something that's also grown extremely in the last 10 years, where you've started to see the combination of these types of strategies. So I do know we also, of course, I highlighted it early on. We mentioned people are able to trade a lot more now thanks to technology. And so one of these, I'm going to try to and talk through this video very quickly. This is going to show you just a sneak peek of what we have now with the mobile app. Remember, if you're out there, you're on the beach, you need to check your options trades. This is something that's nice that is available to you. So when you are in the app, you're logged in, you will be able to pull up a symbol and start to look for, and you see that chain there. It'll say options. You now, of course, as we've talked about, calls, puts, buying and selling, there they are. The ability to select that strategy, selecting calls or puts, will then allow you to see what is available for what we talk about expirations and the actual contract that you need to be choosing in terms of strike. Clicking on that, you then are able to do your normal trade. You're able to go through and select either buying or selling, loading up that trade ticket very quickly after analyzing some of the things like volatility, which is a little bit further on in the concept. Some of the actual Greeks are then available. Think about having Greeks in your pocket, Ed. Many years ago was one of those things that only institutions had. Now you can see that and utilize that for your decision making. Also, once selecting, you will also find that you can see some of the actual further thoughts or concept within a options contract. So you can see what some of the probabilities are. You can choose, of course, your amounts in contracts. We mentioned that multiplier earlier, selecting the amount, selecting the strike, making sure that all that information is correct to place your trade. Once again, all in your pocket. Just a fantastic thing to have with the phones. I'm sure all of you have phones ready and willing to go. So this is nice to have ready to go and to make things really simple for you in terms of management. There's a little other headliner for our next episode coming up here shortly. Previewing and placing, make sure you're on that right side of the contract. Make sure you've chosen the correct things that we've talked about a little bit today. There's that ability to choose your midpoint and to see some of those key statistics I mentioned earlier are important to that decision making. So this was choosing a call. So you can see that there is your pretty much unlimited max gain, and that minimized loss. The only amount that you can lose is that 586 on this contract. So this looks very much like what we showed earlier. You just don't see the chart in the same way. You don't see that hockey stick graph. This is how you actually put this into place, placing your order and then tracking it on the order screen. You will find that ability to do that. And there you go. Easy, quick, straightforward, all right there and ready in on the mobile app. We're also going to show, of course, we'll get a little bit further in. We'll get into some of the things like the website, how you can utilize that for your option trading. But it's just a nice little sneak peek for you all. If you weren't aware, there it is. For some of you, this may be your default. For others, might be something that out of necessity, you're on vacation, you need to have that ready to go. So Ed, one of those great things about the environment now that we are in with trading, with investing, this ability to have access. That's what we showed earlier.
It's incredible, really, when you show what people do have at their fingertips now, and they can make trades wherever they're at, anytime they want, in such sharp contrast to the way it used to be. We did a few interviews on our podcast not long ago, talking to an industry veteran who reflected on the days when everything was done by phone, everything was done by paper. And when you wanted to trade an option, you found out in about an hour if you got filled. And just think about that and where we're at today with the speed and the quickness with which executions can take place. But I'll point out something you've said. The information that people have access to has led to a more educated options user who's stuck around. And we found that if you learn the product and you use it responsibly, some of that volume we looked at earlier is because people continue to use the product and they're not failing, dropping off, and doing something else. So that information and that mobile experience certainly is going a long way and will continue to do so.
Yep, absolutely. So I know we had a few questions that came in. We're going to utilize this and give everybody 10 minutes in between. We try to be respectful of time, of course, when we're doing these sessions. So this is going to just be a quick look, and hopefully we can answer a few questions on what and option tradings and what happens with at Fidelity specifically. If you are logged into thisisfidelity.com, so you're probably more apt to use this on your day-to-day if you find yourself wanting to learn a little bit more or to try to just test these things out. I think one of the questions was simply, where do I even start? Well, you're in the right place. This is how you start. You could be doing anything right now. You could be scrolling through Instagram, but instead you're with us. You're learning about options and you're learning about the tools that you have available at your fingertips and how this can be something that can help you in your journey to financial freedom here. So news and research options, great place to start. There you go. We got our own little line item that we can choose. You'll also see that there's been some updates recently to some of these tools and the look. We'll also, just a little bit of a headliner for number 3 here, session 3, OptionsPlay strategies is one of the choices. Also, I'll get into the option strategy builder. But we just want to show you this look on the website. So choosing something like Apple happened to be the first one on there. We can go in and see some of the data that we mentioned earlier, calls, puts, the ability to choose between these. And then once we have that, this is that universe of choices that we have to make. That handshake deal that we were talking about when we're entering into a contract, we've got to choose a few things. It's difficult. It's kind of tough to start out. So there's a lot of analysis paralysis that occurs because people don't know where to start. So this is something that you can utilize just going in, writing these things down. We do have under one of our tools, if you go to accounts and trading dashboard, that has the ability to add to what's called paper trading. It's more of just tracking an order. You can put that in, put in a hypothetical amount that you want to trade in terms of contracts, watch how that reacts to price and time. So we do need to choose. We see here that we got a spooky expected report date here, October 31st for Apple. They'll be releasing their earnings. So that's a decision that a lot of traders will make. Okay, do I want to be before or after? What time frame do I want to be looking at? Also setting up and choosing your strategy. Are you bullish, bearish? That's exactly where to start, isn't it, Ed? Like, we don't want to just dive in. We want to have a thesis for what I expect to happen. We haven't said it yet, but the options give you options is the thing that if you're playing bingo at home, you can go ahead and check that one off. Options give you options, gives you the ability to make money in different types of markets. It's one of the reasons we choose it. We can trade when prices are moving sideways. We can be bullish, bearish. That's a little preview for the next session with selling, where we're maybe more neutral in our trades. But I can just go ahead. I'm just going to take you right through. We got November 15th, so we can choose our expirations. You can see how many there are. And we have what I call our strikes, which help us to choose sort of the weighting between things, such as how bullish do I or how bearish am I in choosing those trades. So calls and puts. I do also want to answer very quickly another question that came in, which was, can I do these trades in a traditional or Roth IRA? The answer is yes. That brings up the point, you do have to be approved for options. You have to go in and request that. IRAs, traditional and Roth, do have some limitations in terms of what types of trades you can make. But the general basic ones that you're going to be thinking about, buying calls, buying puts, you have the ability to sell covered calls. You can do cash covered puts, something we'll talk about shortly. Those are available in IRAs and Roth IRAs. So just want to keep that note there. There is something that is called naked positions that a little bit step further down the line, and those are not available in there. But we make our choices. Again, I'm just going to at random calls on the left side, puts on the right. We can go in and see where Apple is trading at 224. We can then select and choose what type of trade we want to place, choose our account, and go through that same process that we showed very quickly through the on the website. So, or it should be on the app. This is on the website. There you go. Preview, place order. That's how you get those initial ones in. Ed, though, what do you think about this in terms of where do we start? What is the first thing you tell somebody to do? It's not jumping in and placing a trade. I'll tell you that. You do want to make sure you understand the trades. But what would you say to that question?
Yeah. So first of all, we got the education, you've practiced, you've done your small trade. First of all, you're starting small. If you're just beginning, it's one lots, it's two lots, but you've done your thorough education, you feel good about it. You've practiced, paper traded a little bit. You have a feel for how things evolve over time, because options are not set it and forget it. You don't execute a trade and then check to see how it's doing at expiration. You're looking at things throughout. We're going to focus on session 2. What types of things are you looking at and what types of things are you doing? So be familiar and be aware of all of that. I do want to highlight one thing you pointed out there, or that was on the screen before, is that earnings indication. That is incredibly useful. We can do a whole session on this with respect to options, but when you know when that earnings is, think about options as having a price element reflective of the potential for the stock to move. We all know earnings is a trigger. So options are going to be priced quite differently if they expire just before earnings versus just after. And keep that in your mind, because if you're looking at different expirations and you're wondering, why is this so much higher than that with only a little bit of time in between, earnings is often that answer. Having that laid out right for you as it was that Jonathan was showing is very helpful.
Yep, absolutely. Now we're coming up on time, so do want to be respectful there. So we have a little bit of extra time to get some water, right, Ed? But just wanted to show again, there's a lot here. There's so much option statistics, and you can see, as mentioned, it is a process that you will be that takes. In fact, I'm still learning, of course, all the time. I'm learning about all these additional, more advanced topics as you move through. You'll get into what are called Greeks, and we talk about things like synthetics, and there's a lot that can be it's very rewarding in the long term in terms of that lesson plan, but you need to make sure that you're just seeing and coming to these things and learning a little bit more. I mentioned earlier, fidelity.com, you do have the ability to go in through our learning center, learn a little bit more, join us for some of these live sessions throughout the month. We do these, if you go to events, you can find them here at our coaching sessions, which are one-offs, where we'll talk about individual types of concepts, like we'll do a full hour on covered calls or a full hour on buying calls, for instance, right? We spent 10 minutes on it here. So it's one of those things where we can dive a little bit deeper. In our classrooms, we also have available for you, once again, options for beginners. You step it up a little bit, you go to our intermediate ones along the way. But Options for Beginners has 4 classes each month where we will dive into the basics of trading options. You can see they're starting September here, 5th, 12th, 19th, and 26th for 1 hour. And we have some of our slides and ability for you to register. That'll be available. I think in the Q&A, a lot of you will probably be seeing that link there. We are right at time. I'll go through and also read a few of these Q&A questions, maybe spend a little bit more on the back end of this. But Ed, always a pleasure. If anybody's not able to join us, we appreciate it. We appreciate you coming to something and spending some of this time and educating yourself and learning a little bit, giving us your full attention. Always appreciated. And again, I definitely appreciate Ed and your time. We'll be back in 10 minutes. Ed, any final thoughts for anybody that can't join the other sessions?
Well, just a final thought wrapping up this one. You alluded to it, Jonathan, but learning options is a matter of repetition. I've been in the business 27 years now. I still get questions that make me think. And my team, with over 100 years of combined experience, still discusses questions. That's the fascinating part about options. It takes time. For everyone's different. You might need to hear something twice or 5 times or 10 times, but it takes time. It's a matter of repetition. Sooner or later, it starts to sink in. So don't get discouraged if you heard things that you didn't quite sink in today, but hopefully everyone found it valuable.
Thanks, everyone. We are back. Hope you got a power nap in 10 minutes. Not a lot of time, but nice to be back. We are ready to dive in a little bit further. We did just some of the basics of buying contracts. We talked very briefly about selling contracts, which is going to be the main event today. This is managing your premium selling strategies. So we'll get into, of course, what these strategies are, but also what happens after. A few of you had questions in the Q&A asking about, what do I do? Like, what's this assignment that you're talking about? So we'll get into it. Some of the risks that are part of this trading strategies. Of course, my name is Jonathan Lord. If you weren't joining before, I'm part of the trading strategy desk. Many years of now with education, also a long time coming in terms of options trading. So I'm excited to again impart this knowledge on you all, show you some Fidelity's tools, and talk about some of the ability to use these in your own trading here at Fidelity. And of course, I am joined once again by Ed Modla, the OCC. Great to see you again, Ed. We're going to let you take things away. We're going to get right into it. We got a lot to cover, so we don't want to spend too much time. Slides are available down at the bottom of the screen. The Q&A is still open. You'll see it. But Ed, how are you doing?
Doing good, and thanks again for the intro. Yeah, we're going to dig deeper into those selling strategies that we teased a bit in session one. So we do want to get through a lot here in session two. A couple of disclaimers to start off the slides here today. It's all going to be about covered calls and cash secured puts, two very popular strategies. Don't mistake that for any recommendation that if you're a beginner, these are the strategies to use. Not the case. Everyone chooses for themselves what strategies they'd like to use, but these are popular ones. And so we wanted to get into some detail here on how they're put together, how to manage those positions, and have that discussion. First, with covered calls, as always, you're starting with a plan, and it involves making sure whatever positions you have in your portfolio, in your account, are consistent with your market outlook. You're also at the same time managing money. I think some investors tend to forget that. This really isn't advice in any way, just a reminder. You're managing an account, and a certain percentage of your portfolio you'll want to allocate to a particular position depending on your confidence level. The more confident you are, the higher of a percentage you're willing to tolerate. So you're managing money, managing your positions, but when you have drilled down using fundamentals or technicals or whatever else it is that you're using to find a market forecast, you're deciding what stock am I interested in trading, and the covered call position is going to be consistent with somewhat of a neutral, but a bit more moderately bullish position. Not aggressively bullish, certainly not concerned about downside. You are bullish, but moderately. That you think the stock will drift higher of a certain magnitude between now and expiration. The covered call has two pieces: buying stock and selling call. These could be executed simultaneously if they are, it's called the buy right position. If you're scrolling through strategies, you might see buy right, might not see covered call. That's buying stock and selling call at the same time. Covered call then really is the same thing. It's these same two pieces, but in the more traditional manner. Covered call might involve owning stock and then at a later time overlaying a short call position on top of that. There's a distinction there. This element of premium always comes in when you're selling options, calls and puts that we're going to talk about here in session two. The amount of premium received needs to be worth the obligations associated with it. And investors are going to decide on that. What strike price am I interested in? What expiration? And then what's the premium there? How much can I get? And it certainly might be the case that as you're looking at selling calls against stock or looking at doing a buy right, you've chosen the strike price that you really want and the time frame. But when you look at the premium, you decide it's just not worth it for me to do. And that could be where you evolve your selection process. Maybe you don't do the covered call at all, or maybe you look to change the strike price and or expiration date to get to a premium that you're comfortable with. And then you decide whether to execute the trade from there. But either way, here's the construction of the covered call, either simultaneously or separately. The investor is writing or selling a call contract. That's one call contract, while they are buying or have already held existing shares of an equivalent amount. Now, remember, each option calls for the delivery of 100 shares. If you sell one call contract, you are obligated to sell 100 shares of stock at the strike price. In order for that position to be covered, your obligation needs to be covered. That means long 100 shares of stock for each call contract that is sold. If you have fewer than 100 shares, you cannot sell a call option and consider it covered. It is that minimum level of 100 shares. So now you're long stock. focus in a little bit on about what it means to have that short call position attached to it. This means the investor has an obligation to sell 100 shares at the strike price if they are assigned. Assignment generally occurs at expiration if the stock is above the strike price. It could occur on any trading day. Equity and ETF options, for that matter, are American style. That term has nothing to do with geography. American style options can be exercised on any trading day up to and including expiration. This is in contrast to European style. Again, nothing to do with geography. European style generally are your index options, and they can only be exercised and therefore assigned on their expiration day. But equity options that we're talking about here today can be assigned on any day. Typically, that doesn't occur. For call options, the circumstance that might provide motivation to the call holder to exercise early could be an upcoming dividend payment. Call option holders are not shareholders, therefore they're not eligible for a dividend distribution. If a call holder would like to get paid a dividend, they would need to exercise prior to the ex-dividend date, and then they would become a shareholder of record eligible for the payment. That's the circumstance that might yield some early assignment activity, but more or less assignment occurs at expiration when the stock is above, particularly if it stays above the strike price. Now let's look at putting this together in a little deeper sense. One thing that investors often struggle with when they're starting out is, how do I select the strike price? And then how do I select the expiration date? So let's talk about both of those. First, with strike selection. Generally speaking, the strike is the price target for the shares. Where do you think the stock is going to go within this period of time? That becomes the strike. That is the ideal location for the strike. Now, of course, when you're selling calls, the lower strike, the better, because you're getting more premium for that. But you also want to give the stock room to run. In the perfect situation, the perfect ideal situation, you sell a call option, the stock rallies all the way up to that strike price and stays there, and that's where it closes at expiration. The merging of those two pieces is perfect. Now, once you've determined where you think the stock is going, you can evaluate your confidence level. If you want to prioritize getting more premium, you might lower your strike price a little bit, knowing your shares can get called away sooner. Or if you want to prioritize giving the stock more room to run, you can raise the strike price, get less premium, but greater profit potential because you're giving the stock more room to go. This is that balance that investors are going to have to go through with each and every trade differently. Now, you can set yourself rules and say, this is the way I do it every time, all the time. That's fine. Or you can treat each circumstance unique to itself and decide, how aggressive do I want to be? Do I want to prioritize premium? Do I want to prioritize the stock moving higher? Where am I going to make money from? All the while knowing what I said before, as you go higher and higher in strike for calls, the premium gets lower, and at some point, it might not be worth selling the call option for just a minimal amount of option premium. Expiration selection. This generally comes in the beginning when you're developing your market direction and thesis and outlook. Expiration is often assisted by some technical analysis, where the stock might go and how long it might take to get there. You can look at historical experience of the stock price and what it's done over certain time frames and gain some sense for timing. There might be something on the calendar. Maybe it's a macroeconomic event. Maybe it's something specific to the stock itself, but some sense of timing where you can select your expiration, with also here looking at premium. The more time you have, the greater the premium is going to be, and that's going to give you more of a buffer to the downside as you're collecting premium against the long stock position. So more time is greater premium, but if you go shorter in time, that premium evaporates faster. So look, options are always about pluses and minuses, advantages, disadvantages, benefits. You're weighing things against each other. So, Jonathan, I'll bring you in here for comments. Strike selection, expiration, a lot to unpack. I think this is where one of the many places trading options becomes exciting and where I love it, but there's a lot to think through. So what do you talk about with investors, and what are they asking about with respect to strike and expiration?
This is when we think about the steps that you have to go through. You mentioned earlier, we need to think about, are we bullish, bearish, are we neutral? That's your first step. Then, of course, you make sure you know what underlying you're trading. You need to have that thesis based off of that underlying. So again, that can be a stock, an ETF, an index. And then you've got to start making more decisions. It's so many decisions. And a lot of people, that's where that I mentioned earlier, analysis paralysis comes in. They say, I don't know what to choose. I can't choose. I can barely choose when I go to a fast food restaurant, what I want to eat. How am I going to choose from the thousands of strikes and expirations and the different ways that those mix together? It's just part of the process, and it is difficult for a lot of new traders, as you mentioned. So you need to first sort of understand that there is that spectrum or that balance that goes into choosing and selecting these things. I'm bullish. But how bullish are you? How much, well, how far do you think price can go? How long do you need for it to occur? How much time or how much volatility are you willing to accept as dependent on the expiration or time that this contract is in place? There's more uncertainty as we move further out. The market doesn't just give that to you. You have to pay a little more. You get to technically receive a little more, but we'll get into there's even more nuance there. But these are the things that you have to think about. Again, I always just think of these sort of scales. You're trying to find the one that fits for you. And we talked earlier, hey, you've got that app, you're on the beach, right? If you're a person that spends a lot of time on the beach or away from a computer or away from thinking about these things, really short-term expiration is probably not for you. Those are ones that need a lot of management, a lot of work. So for some traders, they just have to sort of, and this is actually full circle around the Thales that again traded the first options contract. He was also the one that came up with know thyself. And so know thyself is exactly what you need to have in place when you are trading these, because you are making the decisions in terms of strike selection and expiration. So know thyself, know what works for you, where that balance lies. I sit here all day in front of a computer, not great for my eyeballs, but maybe great for shorter term trading options, isn't it? Because I can manage that and I can adjust and I can sit here and see that when a profit target was hit, I can adjust and maybe change, roll out. We'll get to what that means, the expiration. If you're not paying attention, if you're not setting alerts, if you're not constantly watching these things, then short-term options probably not for you. You may need a little bit more expiration time that may then need to adjust the sizing. We'll answer some other questions. Somebody had a fantastic one that I want to get into, which was about what are some of the pitfalls for early investors? And this is the area where the pitfalls start happening. They start trying to go too far bullish or bearish in terms of strike selection. They try to go too short because it's cheaper. They think, oh, it's cheaper. It's easier to buy really short term expiration high contract. And then what you end up finding is that they're not putting the numbers on their side. And that's what you need to understand when trading options. You need to make sure that you have the full understanding of these before you dive into it. Somebody talks about options, can't remember who said this is, but it's a lot like fire, right? Fire's fantastic. It's great. You need it. You need to cook your food on it and warm your house up. But out of hand, fire can do what? It can burn a lot down. It's very difficult to control once things get out of the way. So you need to have this and know what you're doing because can be a lot like playing with fire when it starts trading too big of size. So this is where some of the thought concepts coming in. I'm throwing a lot at you here, but strike selection and expiration selection, reading about these things, watching them. I'll show an option chain again to help you to sort of think about that spectrum, but finding that balance is really important to all traders.
Yeah, you're right. It's nuanced. There's a lot of strikes, a lot of expirations, but you are trying to do a few things. So hopefully this commentary that we've had back and forth can give you that start. Yeah, we didn't talk about quantity here, Jonathan. Another tough one that people start to think about when it comes to covered calls. I'm like, do I want to cover the whole position, the part of it? But again, with experience and comfort level and education, there's a lot you can do here. Let's look at the traditional classic construction here, covered call, two pieces, long stock, we'll say at 59. and perhaps we've had this position for a while, and all of a sudden we don't think this big move higher is going to occur anymore. But we do think that a move to 65 looks feasible. But beyond that, we really don't think the stock's gonna rally up into the high 60s. So we're comfortable selling a call option. Maybe it expires, a couple months out or so at 65. That's a strike price. If the stock rallies through there and we hold this position, we're going to have to sell stock at 75. We have to be comfortable with that. On some level, we have to understand our shares might get called away at 65. We're okay with that. We'll take the $6 gain there. We're also going to get paid. This is $225 up front immediately when we sell the call. No matter what happens with the stock, it could stay at 59, it could drop, it could consolidate, it can even move a little higher. 61, 62, 63. If it doesn't get to 65 and its expiration, it's likely the option just disappears, goes away. The option holder doesn't exercise, and that 225 is just ours to keep. And this is why investors gravitate often towards the covered call. They get the premium. It could be added profits. If the stock stays here in the low 60s, it lowers the break-even point because our total cost of the position is now less. So now we could actually see the stock consolidate at 60 or drop very slightly, and we'd still be profitable. This is risk reduction. Options have a reputation, of course, and one of the misconceptions is that they're high risk. Not necessarily true. They are complex. It takes time to learn and understand them, but if you use them a certain way, they risk. And that's what we're doing here, lowering risk, lowering break even. We have a more conservative position than if we just held long shares of stock. And you can calculate now your maximum gain. If we're a long stock, we can rally indefinitely. With the covered call, as it stands, if we hold it, we can only make money up to the strike price of the option. That's 65 or a $6 move, and we can calculate our gain. Investors might want to do this. Jonathan, as you're looking at this, things might come to mind, but investors might want to say, okay, I'm going to calculate this. Now, let me look at the 67 strike and see what that looks like. And let me look at the 63 strike and calculate that. And that might help someone determine strike price and expiration. But as you look at this graph, what other things are investors thinking about, knowing options really aren't set it and forget it? What investors need to be looking on the out for?
Yeah, absolutely. And again, this is seeing that mirror image once again of we had a call, which was really just this flipped and turned over, wasn't it? Where we had a limitation in terms of the loss, and we also had unlimited gain. This thing is flipped. We have a limitation in how much we can actually receive here. There's a reason though for this, and there's a reason why this is also one of the most traded option strategies and where a lot of people start with is because it is, in terms of the risk, there's not a lot there in terms of the option itself. There's some risk that you miss out on potential profits if the thing just rockets higher. A lot of traders are looking for this though, for that sort of income stream, that process of creating some income to bring into their accounts. And it's slow and steady. It's the again, the tortoise and the hare here. This is the tortoise, and you're not getting that sort of unlimited profit potential, but you're playing, in theory, the numbers to your advantage here. I don't think price is going to get above this level. How often does that happen? If you're a long trader, you'll probably find a lot of times where you were just way too early and it just never got to that price, or it didn't get far enough and price just did nothing. Well, this is a way to profit off of that. It's a way to sort of set up a trade that says, I can bring in some income, create my own, almost like a dividend, bring that in, and then allow that to slowly over time continue to accumulate and accumulate. We'll get into some of the strategy here that goes into that, how we might roll, how we might change or adjust. But you will find this, and a lot of traders will utilize this as a slow and steady income stream that adds up over time. The thing that you do need to remember are those couple things. Number one, if price gets really high and you start to have if you do get a dividend and it gets close to that expiration, it gets close to that strike price, there is very well that you could lose your shares. Or if price does move above that strike price, you are required to do what? That handshake contract delivery. I have to deliver those shares to the buyer of the call in this instance. And so that is what you are entering into as an agreement. There is something where traders will go, well, I didn't want to sell the shares. Well, then you shouldn't be selling a covered call, because that is the end result, is a selling of those shares. And as an assignment, I mentioned earlier, something that happens to you, you can't really get in front of it. You have to sort of wait, and you find out oftentimes the next day that you were assigned and there's nothing you can do. Most of the things that we do is we try to reduce the risk by, or what's called assignment. And it's slow and steady. It's the again, the tortoise and the hare here. This is the tortoise, and you're not getting that sort of unlimited profit potential, but you're playing, in theory, the numbers to your advantage here. I don't think price is going to get above this level. How often does that happen? If you're a long trader, you'll probably find a lot of times where you were just way too early and it just never got to that price, or it didn't get far enough, and price just did nothing. Well, this is a way to profit off of that. It's a way to sort of set up a trade that says, I can bring in some income, create my own, almost like a dividend, bring that in, and then allow that to slowly over time continue to accumulate and accumulate. We'll get into some of the strategy here that goes into that, how we might roll, how we might change or adjust. But you will find this, and a lot of traders will utilize this as a slow and steady income stream that adds up over time. The thing that you do need to remember are those couple things. Number one, if price gets really high and you start to have if you do get a dividend and it gets close to that expiration, it gets close to that strike price, there is very well that you could lose your shares. Or if price does move above that strike price, you are required to do what? That handshake contract delivery. I have to deliver those shares to the buyer of the call in this instance. And so that is what you are entering into as an agreement. There is something where traders will go, well, I didn't want to sell the shares. Well, then you shouldn't be selling a covered call, because that is the end result, is a selling of those shares. And as an assignment, I mentioned earlier, something that happens to you, you can't really get in front of it. You have to sort of wait, and you find out oftentimes the next day that you were assigned and there's nothing you can do. Most of the things that we do is we try to reduce the risk by, or what's called assignment risk. We might change or do some of the things that Ed's going to be talking about here shortly, which is rolling, changing, the adjusting, in order to allow this to continue to be a profitable trade for us. But just the other thought that I have on this one, you'll hear this often brought up as well, as if I'm going to sell the stock at maybe a certain price anyways, this might be a viable option for you. To think about, you own, in this case, the stock that we have, XYZ, and XYZ, I was going to sell it at $75, right? Maybe I have a profit in mind when I entered into the trade. I'm maybe a little bit more tactical in my trading, and I was going to sell it anyways. Instead of just leaving a limit order out there, you might sell the covered call, and that allows you to bring in income if it doesn't get to that price. So this is still, though, a neutral to bullish strategy. I do want to emphasize, even though it is on the other side of the call contract, we mentioned a long call is bullish, covered call is actually still a neutral to bullish trade because of that additional shares that we've included in there. That changes everything. That is the rabbit hole, right, Ed, that you can go down, is when you start to add and mix and match shares, short shares, options, buying calls. Or you can put them all together, and it's actually in a few different types of trades where you're mixing multiple types, buys and sells. We have some fantastic names for those. That is where you could start to get into as you start to move up into the intermediate to advanced levels in the options world.
Yeah, absolutely. Yeah, the short call by itself, that would be more consistent with bearish. The short call, if we pair it with long stock, all of a sudden it's now a bullish strategy. And yes, great point. Assignment is a part of the package here. If you absolutely cannot tolerate assignment, then take a pause on whether or not this position is for you. However, some investors will say that they intend to manage that. So let's take a look. I'll walk through a couple of different ways to manage these positions. Once they're established, we've now moved on, and the stock has started to move, and market dynamics are changing, and we might want to do some things with this position prior to expiration or prior to closing it. The term rolling overall just simply means we're closing out what we have and we're opening up something new. That's really all that it means. In this case, rolling up is referring to rolling up the strike price. We have this covered call position, utilizing our numbers here. I don't want to forget what they are. So we're short the 65 call, stock's 59. Let's say the stock has started to rally. It's gone to 63, 64. And we don't want to be assigned at 65. Now we're a little more bullish. We think 70 is in play. 75 might be in play. So we decide, if I don't like assignment at 65, I'm going to roll this up because now I have more confidence this stock is getting to 70. So rolling up would involve buying to close the short call, writing or selling to open at a higher strike. Now we're buying the more expensive options. We're going to pay a net debit for that. Means a little more out of pocket. That's going to raise our break-even point on the overall strategy. But since we're giving the stock more room to run, we now have an increased overall maximum profit potential. In our example, buy to close the 65 call, sell to open the 70 call, could be done as one singular order, as a package spread at one price, a net debit between the two, or you can execute these separately, buy to the 65 call to close, and then work to sell the 70 call separately. You can also choose a different expiration date. Those types of rolls are referred to as rolling out. We're not doing that specifically here. Rolling up is straight up, same expiration, going from 65 up to 70. Rolling down is the same thing, maybe different circumstances here. We're long stock at 59. Maybe it sits there at 59 or it drifts a little lower, 58, 57. And we're not so bullish anymore. We're not bearish either. But now we're thinking maybe our 65 target's a bit aggressive. So we want to roll that down to lower our risk, and we're willing to get out of the stock sooner. So buying to open the open short call, writing or selling to open another call with a lower strike. The lower strike is going to have higher premium. So this will be done for a credit. We'll bring in some money, some cash goes into our cash balance of our account. This will lower or improve the break-even point. But overall, the maximum profit potential comes down because the stock gets called away sooner. As an order, this might appear this way: buying to close the 65 call, selling to open the 65 call or 60 call. So rolling down in strike at a net debit single order, or possibly doing this separately. So rolling up, rolling down. You could also, with either of those, consider the prospect of rolling out and having your new short option be at a later expiration date. And here, just a reminder to everyone, the covered call is consistent with moderately bullish, and investors sometimes feel like, well, if this works, it's worked once, it's worked twice, it's worked often, it always works. So, but it just takes one bad experience to realize that there isn't a whole lot of protection that the covered call offers to the downside. If there is a significant move lower, if there is a big sell-off, this position is going to suffer, and investors need to be honest with themselves when that happens. Is this position truly consistent with my market outlook, or am I just apprehensive about taking a loss? I'll cover it at the very end, but the psychology of trading comes in here. The hardest trade anyone ever has to make is seeing a red number on the board and closing that position. I've been there many times myself. It's difficult to do. It's just something about seeing a red versus green. No one wants to close out the red, but sometimes it's the best way to go. When we close up, I'll share insight on how I got through that dilemma. But here you go. Close the position. If things aren't going well, sell the stock. Buy to close the option. Could be done as a single order. You could do them separately. Word of caution: if you do them separately, you likely have to buy the option back to close first and then sell the shares. The reason is, if you sell the shares first, you're left with this, Jonathan mentioned it, naked call or exposed call option that's not covered. You don't have the shares to cover obligation anymore. So doing the shares first might get rejected. You might not be allowed to do that. Careful to keep in mind, if the market is crashing and you're trying to sell a stock position, you're getting a rejected order, that can be a bit stressful. If it's the covered call that you're trying to sell shares on, that might be the reason. You cannot leave yourself with an exposed naked call position. Different ways to manage the position based on different things that are happening in the market. But all in all, watching, evolving, and then doing whatever you think is necessary. So cash secure puts, this is a little quicker to understand. There's not as many moving pieces. Now, first of all, the basics of selling put options in general, you want to generate the income. You want to receive the cash into your account from the option premium. That's true with calls or puts. Here, you might be looking to acquire stock. That's what we'll look at on the following slides. But if you're just selling put options, if that's your motivation, I want to make money off the premium itself, you're accepting the obligation to potentially buy the shares at the strike price. You have to be willing and able to do that. Your forecast is neutral, or even for prices to increase. If that were to happen, the option premium would disappear and you would profit directly from selling puts. You might have a little bit of a different motivation here, which is selling the cash secured variety in effort to buy stock. Maybe you think the stock's going to dip. It's a little bit higher than you'd like to buy it. So you're looking for something to the downside below where the stock currently is. Jonathan, I know I get questions asked, why don't I just use a limit order? What's the difference? Benefits, disadvantages? What would you say to an investor who's like, can you compare cash secure puts and limit orders?
Yeah, absolutely. It's one of those things that, in theory, placing the actual trade and sitting there and having that control, that is something that a lot of traders will try to think about. Cash secured puts often is, like you said, it's a way to acquire those shares. You need to have that thesis, though. You need to have that strategy in place that says, I am bullish on this, but maybe I have a certain level or an area of interest that I want to get into the stock. We'll also talk about this next session coming up with OptionsPlay. They get into a lot of this, which is things like the wheel strategy, which is a combination of the two in order to acquire shares and then to bring in income. And then if you get assigned or on one side or another, you just continue to do this trade in order to continue that income stream and profit from stock movement at the same time. Oftentimes, once you've started to acquire that, it's fascinating. It's a slow and steady process, and knowing the risks and rewards of doing one thing or another is important, right? So if you again have that limit order out there and that thing gets filled, you need to remember that that's you are owning those shares, right? Once you own shares, your max loss is the total amount of the shares that you own, isn't it? They can keep going down, and we've seen it. You may have traded it, you may in your own account been involved in a position that just continues to go down and down. You say it can't go down any further, and Ed, what's the story? Yeah, it sure can. It can keep going until it doesn't ceases to exist. We've seen it. So that is one of those things that you need to keep in mind when you are owning those shares. Selling puts, when you think about that, is just setting up an order. You are putting that out there and you're involved. You now have, if this thing stops or if this thing gaps down overnight, some news comes out in the evening, what happens? Well, if you have that limit order out there, Ed, you can go out there and catch that order. You're not on the hook for it. But if you're if you sold that put, you can't go out there and just say, hey, I went out of this now, or whatever. You wake up the next day and you are at part of that trade. So it's something to always think about is if you find yourself, if you're very, very risk averse, then it might not be something that you want to do. Now, there are other aspects or ways to limit that risk. I'm not going to get into it here, but adding on additional types of contracts, again, is something that more intermediate to advanced will start to utilize things like spreads to assist with that. But you need to know the risks, and you need to know that anything and everything can happen. You are trading one stock or index or ETF. And Ed, I can't tell you how many times the last couple of years I've heard once in a lifetime things keep happening over and over. I'm like, well, I can't have 5 once in a lifetime things happening in the same year, right? That's what trading does. Anything and everything can happen. You need to be prepared for that, and you need to know what the risks are of selling those puts and having that position size in place. That is something that I've ran into a few times with traders. They went in there and they saw those premiums and they thought, I can just and again, you can actually use, in some cases, margin in those instances. This is a cash secured put. So we are saying, hold aside the full amount of cash necessary to buy the shares. But what they ended up finding was that they had opened up more than they really were comfortable with. And when the assignment came through and the shares were in their account, this was by far their largest position, and the stock continued to move lower. and they started to see, and again, continue to have to participate in those losses and then have to adjust. Suddenly a short-term trade turns into a long-term holding, doesn't it, right, Ed? That's always the joke. And you find that, but it's at the end of the day, it's not a joke. It's money that is been used, and you have to decide where you want to position that. So important to note, while this is a conservative type of strategy, it's very akin to owning those shares. There is risk there if you don't use it wisely, or in terms of your position sizing and know those trades.
Yeah, spot on analysis there, and words of caution very well taken. If investors tend to get overconfident, the market has a good track record of humbling people who think that trades always work. They'll always be in a good position. Let's go through an example. This is fast because there's not as much going on here. There's just one position. You're short a put option, say at the 90 strike. You have $1 or $100 that you brought in from the premium. So you've got another $8,900 outside of that to potentially come up with the $9,000 to buy stock if you had to. So, stock's at 100. That's where this red dashed is. We're selling this put option here at the 90 line. Our break-even point would theoretically be 89 if we were assigned and bought the stock, when you consider that that $1 premium received. Now, just the option itself, we can only make that $1. Keep in mind, we're 10% out of the money when we're doing this, but that's the only profit potential we have just looking at the option itself. But now let's just look on either side of that. If we reach expiration and we're above 90, well, it's pretty simple. The stock has stayed above 90. The option is out of the money. We're likely not going to be assigned, and the option just expires worthless. We can reevaluate and decide what to do. Maybe that involves selling another put option. Maybe it involves doing nothing. We simply reevaluate and decide the best place to park our capital. Below 90, it gets a little bit more interesting. The put option is now in the money. We have the shares. Maybe we want the shares. Maybe that's exactly what we wanted. We're long stock from 89. That's break even, purchasing the stock at the strike price minus our premium received. And Jonathan mentioned the wheel strategy. Do we now sell calls? We sold the put. Now we're assigned. We've got long stock. Do we want to start selling calls at 95 or 100? Do we want to just hold the long stock? Or do we not want the stock at all? We can look at a protective put. We can go on and on here about different things you can do with options once you now have a long stock position, and we've covered some of those. So certainly if you have any questions about that, send them through. Jonathan, before we get to demo, let's just sort of recap, overlook. Investors need a plan. Options don't trade themselves. Have a plan, stick with it, but watch the market because things can change. And then when it comes to position management, knowing it's the right time, I told people the most difficult trade to do is the one that locks in a loss. I've had many horror stories of not wanting to do that and being frozen, looking at a bad position get worse. I got over that, and it's very quickly by always thinking about the opportunity cost. When I'm in a losing position, the best thing, or the only thing anyone cares about, is making that money back. But is this the position that is best suited to make that back? Maybe it is, and I'm going to hold it. Or maybe there's another opportunity somewhere else, in which case I'm going to lock in the loss and move my money somewhere else. That might be cash, but somewhere else. Constantly thinking about that other place that might be better than this one. I'm not going to hold it just because I'm afraid of taking a loss. I've been there myself. It's difficult. But Jonathan, it's just part of the psychology of trading. And I know you have thoughts on that. And of course, want to share and take a look at a few things on the Fidelity demo here in this session.
Yeah, absolutely. Again, we've been on the soapbox a little bit here. This is important because, as I mentioned, I've talked to and seen thousands and thousands of clients and their accounts and the successes and the evaporated earnings and amounts that they had out there, and just evaporation of wealth, I should say. So this is always important, is to remember that you are placing these trades. You are the one that is behind this. There are some processes such as just paying attention, thinking about, okay, if I were to do a covered call, what would that look like? All right, well, let's enter that in, write that down. What's the price now? What's the price going to be later? You're selling that call, and you're going to hope to buy it back later at a lower price. What happens to the stock? What is all of this sort of put together? You don't have to go out there and, again, just start completely diving into these trades. A lot of times it's learning a little bit because of how much there is to think about. You mentioned that consider your stock forecast, though, and that's coming up multiple times, right? Like the exit on that covered call, for instance. One of the things you can do is just get out of it. We don't need to just keep holding and keep putting money into a bad trade. And so that adjustment is important, and having that sort of process. So let's take you through a process. Let's show you what something like that might look like. What I'm going to do is go in and take the screen here and show once again fidelity.com with our remaining time here. And I'll try to get to a few questions. I know a couple came in on exercise and assignment. I'll rehash a little bit of that. But what we've done, and I went to news and research stocks, and what you find here is, of course, some of the biggest names and some of the bigger movers, and you can go through and read about and look at either something like an equity summary score, which is an analyst opinion. You can see who and what is being traded out there, the Nvidias, the Teslas, the Snows of the world, and these sort of things. And you can see some of the market movers. I've chosen Nvidia. I'm sure you've seen this in the news if you're following. It's been quite the mover here. So let's go and do a little bit of research. Maybe I have, or I want to trade based off of what I see here. So again, this is just for purposes of thinking about how a trader might approach this. I found my position that I am maybe from the perspective of fundamentally bullish on. Maybe I'm fundamentally bearish at this point. Maybe I think there's too much hype in terms of the earnings reports, and maybe I don't think that they can sustain that, or maybe there's other things out there. Going back to that, again, the olive press, right? It's not going to rain forever. Right? I'm changing my tune here, and instead, maybe I'm going to look at this and say, we showed buying a call earlier. Maybe I think this thing has run its course, and what I can do is look at something like a chart. All of this that has occurred, what's called technical analysis. And we showed earlier, we did the 4-week classes. I am a charter market technician. I help to run those, which are the technical analysis classrooms as well, that talk about how to think about price and price memory. And so what we can do is look at a stock price, and we can say, historically, what has it done? What are some key levels, supply and demand shifts and changes? And so we can try to find those and utilize those for our selection. But this, in the end, doesn't really matter, does it, Ed? What matters is over here, this stuff. This is what we're trading based off of. The time, as you can see on the bottom of the screen, all the way out now to there's November. We're going to be ready for Thanksgiving, right? Cranberry sauce, ready to go. And we're maybe thinking about what's going to happen with NVIDIA in that time frame. You can also see, of course, price. So if we're selecting our time frame, our expiration, our price, we would do that based off of something like this. I can use and look at price and look and see where have been key moments. And if I'm bullish or bearish, what kind of targets I can have in place and what kind of strategies I can use. What we do here, I'm going to go back into that option chain. I showed this a little bit earlier. But what we now can do, here's what the older chain looks like. It automatically is updating to the updated chain. We can see it once again, buying calls, puts, all of these are available with our expirations. There's our November puts. I can see all that in front of me. If you're curious about what these all mean, that's a little bit further down the line. But understanding things like what the volatility of a stock is extremely important. Reading something like a delta is another thing that is going to be, these are two things that you really want to know if you're an option trader as you dive in further and further. Strategy Builder, though, may be a great place for you newer traders to start. I said next. There we go. Goes up, remains flat, goes down. Bullish, bearish. Ed, last time I told you this one remains flat. I call this as a crabbish market, a little sideways move. Trying to see if that'll stick at some point. You can see here, picking your outlook. I mentioned earlier, technical analysis being a key part of that. You can also use things like fundamentals, earnings reports are part of choosing and selecting some of these. But this is your process. I think it's going to go down. Again, I'm just using this from a random, just looking at this because we did buying calls. I want to look at buying puts. There you go. Once again, we see that look that we had earlier where price is moving. Here's our profit. Here is price moving to the left, means it's going down, where those profits start to pick up. This matches with all the things that Ed and I were talking about in session 1, paying a premium. We have max loss that is capped. We can learn more about it, but we select that. And now we start to do some of those other things we talked about, choosing and selecting expiration and strike, our probabilities, putting those on our side, understanding the cost of $760 to buy this put. I can adjust things. I can take things out further. I can go and watch as those start to change the values and the cost. Now I'm paying $1,300 because time is money. in this. I can use this for other strategies, of course. Remember, the selling and option selling is part of this. So if I'm now maybe neutral to bullish, I can also go back and I can change that and say, you know what? I think it remains flat. Now we've got covered calls, cash covered puts, just like Ed and I were talking about. Looks what? The very same. Both of these neutral to bullish strategies, part of receiving that income. It's capped. We have risk to the downside, and we can start to choose and select where we want to take that from here. So this is all part of creating that strategy, looking at that chart, thinking about the position, thinking about what we think is going to happen, and then selecting the strategy, pulling out the golf club that fits, right, Ed? We're not hitting the putter from the fairway, are we? Right? We need to have the right tools, the right strategy for what we see, but we also have to know when we're wrong. We have to use that feeling of this is not remaining flat. NVIDIA is flying or it's dropping. I need to adjust and change my strategy. So once I have something in my account, again, this is a test account. This is not my account, by the way. This is just a test account. Something like Citigroup covered call we have in there. We sold this to open. That's why it has a -1 next to it. It is covering 100 shares, right, Ed? We talked about this. 100 shares, one Citigroup call has been sold at 75. We are attempting to see, we sold it for 76 cents. What's it trading at now, Ed? 6 cents? That's great. That's why this is green. That's exactly what a covered call trader wants to have. They want the stock. The stock did not go above 75. It is losing a little bit on the shares, but this is a great example of I've brought in $70 when the stock didn't do anything. It's down 0.62% in this account. And it's made $70. Again, these are maybe small stakes for you. For others, you can multiply this out, but you can start to see how this sort of strategy, maybe we want to close this out. We've reached 92% gain on this position. I'm going to buy that back. I sold it. I'm going to buy it back, or I'm going to roll it to another expiration. These are the things that traders would start to do and the things that Ed was talking about. Ed, any thoughts here before we take any of those final questions in our remaining minutes?
The big thing that came out to me that I didn't really mention, we were talking about premium selling. It's got to be worth your while when you're looking at strikes and expirations. Didn't really get into it and think about it until you just showed that Citigroup example there. While the trade's open and the call option or the option value is depleting and you're down to 6 cents, that same question applies. Is it worth holding this open position if all I can make is 6 more cents? Now, some people might say, yeah, I want everyone, but some people might say, well, no, it's not worth holding at 6 cents. I'm going to buy it back to close. Maybe I'll sell another option, maybe not. But at monitoring that, when the option value has very, very little left to decay, there's all risk and no reward. That might be a time to start considering position management.
Yep, exactly right. As we start to get into the expiration, and then as you mentioned earlier, maybe we're thinking about dividends, we're thinking about all these things, we can reload. And then we've seen trades, and I've seen clients that had done this over the course of years. The same shares continued to bring in income over and over and over again on that trade, slow and steady. Sometimes wins the race, not always, but and this is one of those types of trades that a lot of traders are interested in because of that ability and how much sense it makes to buy shares, sell a covered call, and allow that and to manage that over time. But as you mentioned, this is not protection. This is, I call it the Swiss cheese parachute. It doesn't give you any protection. There's a little bit of income that comes in, but you're not getting that longer term. You're not really protecting yourself. We've hit that very quickly in the buying puts. We can do what is called protective put. A lot of these different strategies are available too. You can see some of the list here if you're interested. This is how deep we can go. We can continue to, and you can see things like butterflies and condors and all these great names. That is what options allows you to do, is to make money in different types of markets in different ways that fits for you. This is a great place to start. These basic strategies, knowing the risks, knowing the rewards, knowing what the actual process is, not just the end result that we showed there with those hockey stick charts. It's actual putting that money to work and placing the trades and creating a system. That is going to be one of the things that all traders need to understand. And that's one of the reasons it's grown. And we showed how many people are trading this now. There are a lot of you are finding out about this maybe for the first time. talk to people who are traders, see what they're doing out there, use the community, join us at fidelity.com/coaching for more sessions. We would love to have you to talk about these things. Join us for a webinar follow-up tomorrow. Two of my colleagues will be talking through this. Let me go check again. Yeah, that is at noon tomorrow. There should be a link to that webinar follow-up. Once again, more interactive process of talking to us and letting us show you how we can help you understand these things and answer your questions. And the only thing maybe you can just kind of reiterate again, the process of exercise and assignment. What does that mean? A lot of questions came in on that. I think that's one of the most common things we hear about is what actually happens. Again, I've kind of given a little bit of the background, but just once again, headline for us. I've sold this covered call, for instance. What are we thinking about when it comes to assignment and exercise?
Yeah, so sure. So OCC, my ultimate employer, facilitates this exercise and assignment activity. So if we're short the call, short any option, we're always evaluating the likelihood of assignment. Now, in the case of calls here, the likelihood increases when the call option goes in the money, which means the stock has gone up above the strike price, so above 75. Prior to expiration, if it's in the money and there's a dividend, we might want to learn a little bit more about when that early assignment might occur. But absent that, assignment is generally going to occur at expiration if the stock is up above 75. There's a high likelihood of being assigned. Now, quickly from the option holder's perspective, you have a choice. You are in control. Auto exercise, or this process known as automatic exercise, does not mean you have to do anything. If the stock is trading at 75.01, or just a few pennies above 75, you watch some after hours activity, you're not comfortable with Monday morning, you can call your broker up and say, you can call Fidelity up and say, I don't want to exercise this option. Or conversely, if it's trading 74.90, but for some reason you really want that call option, you want those stock at 75 come Monday morning, you can call Fidelity and say, I want to exercise. The choice is always yours. Auto exercise, very quickly, I know we're out of time, is just an industry convenience that if you do not tell Fidelity what to do, and Fidelity doesn't know what to do, and you're long this option and it's in the money, it's going to get exercised on your behalf. That's that auto exercise feature. So keep that in mind. If you're a buyer, you always have control. If you're a seller, you can't entirely be sure what the buyer or holder is going to do, but you can evaluate the likelihood of being assigned based on a few different circumstances that we talked about today.
What a segue. In the Money is just so happens to be the name of the show that Tony Zhang, who's joining shortly here on the hour, where they'll be talking through again what's going on out there in the markets and some of these strategies and basics therein. And so Tony's fantastic. Shows on the In the Money show that is available here at fidelity.com as well. You can see here what In the Money looks like is gray area here is what is called In the Money. So if the stock on a call is if it is 60.46, anything under that is referred to as in the money. For the put side, it's the reverse. So anything below 61 here, you can see is in the money, or excuse me, above is in the money. These are below, out of the money. So in the money, out of the money, at the money would be if it was exactly $60 and $60, that would be considered an at the money contract or close to it. So these are things that you do want to think about. I showed there was a dividend on Citi that had already passed, but those are things that oftentimes a covered call trader might look for. We've hit it all. I know there were so many questions, and that's why, again, that webinar follow-up tomorrow, that interactivity that we will be able to talk to you and show you a lot of that. Join me and my colleagues here tomorrow again at noon. That link was shown since there's so much, Ed. We could do 8 hours of this if we wanted to, but we'll leave it to 2. Once again, we will take a break. Don't leave, don't turn it off, don't change the dial. Join us right back here. We'll be back for of course, Tony will be back for our next session with OptionsPlay.
I'm Roberta King, a Vice President, Branch Leader with Fidelity Investments, and with me today is Tony Zhang, a Chief Market Strategist at OptionsPlay. Tony is also a frequent CNBC guest. Tony, as always, I want to say welcome.
Thank you so much, Roberta. A lot to talk about today with regards to the markets.
Definitely. I'm really excited. It's always great to be back with you. So today's Thursday, August 22nd, and we've had more economic news and numbers coming out this week. And of course, let's get into it. I think we're all interested in hearing what your macroeconomic view on the markets are looking like.
Yeah, so over the past few weeks, we really have had a pretty resounding turnaround from the volatility we saw a few weeks ago. With inflation prints coming in line with expected, retail sales fueling a bit of a surge in terms of consumer spending and kind of alleviation of some concerns that drove the markets lower a couple of weeks ago. We're at a pretty pivotal moment in the equity markets. I honestly didn't think that we'd be back so quickly to all-time highs, given the amount of fear and panic that investors saw, 2-3 weeks ago with the sell-off after the poor jobs number coming out from July. So one of the things that I do think is important to pay attention to here is that, as the S&P 500 gets back near those all-time highs, one really important group of names, if you will, that are kind of lagging behind are the Magnificent Seven tech stocks that have largely driven this equity rally over the past couple of years. If you look at the equal weight S&P 500 index, what you actually see is that the equal weight S&P 500 is actually closer to the all-time highs than the market cap weighted S&P. So what this is telling us is actually the Magnificent Seven tech stocks are actually creating a bit of a drag here on the market cap S&P 500. In addition to that, what we're starting to see is that sector rotation is quite poor. We've been talking about the fact that for months and months leading into the recent all-time highs, we really didn't see a lot of sector rotation. It was really just technology and a little bit of discretionary leading the markets higher. Right now, we've kind of gone right back to it after we had this panic sell-off, and the rally subsequently has largely been driven by just one sector. So when you think about that, those are not necessarily the healthiest metrics to look at for markets to reclaim all-time highs and continue moving higher here. But we do have two, I would say, important numbers that are coming up here other than economic events that I think is going to be a primary driver of equities, which is going to be NVIDIA's earnings next week. We obviously have seen a bit of a reversal in NVIDIA today. This is really kind of speaking to the fact that investors are still being very cautious with regards to stocks that are trading at very rich valuations due to kind of the AI revolution. Investors are being a little bit more skeptical as to whether or not these valuations are justified given the potential future income that they expect to be able to generate from this over the next few years, given how large the investments these companies are currently making across the Magnificent Seven tech stocks. You also have Apple's upcoming launch for the next iPhone, which has a lot of AI baked into kind of the valuation. So those are two things that I think will likely going to influence the market's decision and direction for the overall markets, depending on how NVIDIA's earnings comes out, or rather how investors react to NVIDIA's earnings announcement, and also how many iPhones Apple's are able to sell, meaning how much are consumers willing to part with what is more and more scarce cash in their pockets for that new iPhone in order to activate some of the new AI tools that Apple's introducing into the new iPhone. So these are some of the things that I think are concerning to me, that I think investors should be paying attention to as we approach all-time highs. And we're asking ourselves, can equity markets break back above recent all-time highs and continue moving forward from here, given the valuations that we're at, given the concerns that investors currently have, and given the internal metrics that we see here for the equity markets? There's some cautious optimism that I think investors need to have with the approach to these markets at all-time highs.
Thank you for those thoughts. And I actually really appreciate that you mentioned, Tony, the volatility from 2 weeks ago. It was brief, but I am one of those folks that definitely believe in the power of perspective, meaning we're now about 2 weeks away from it. It's in our rearview mirror. I would love to get your take on what happened 2 weeks ago.
Yeah, I mean, you mentioned that it was brief. It certainly was brief, but it was very, very violent. And I think that that really spooked a lot of investors. Now, I do think that markets overall overreacted a little bit to that poor jobs number on that given Friday. I remember when the jobs number came out, the only word everyone was talking about was recession. And 2 weeks later, it seems like recession is no longer something that anyone is even thinking about. You know, it really was a bit of a perfect storm here. You had Japan raising interest rates. You had a poor jobs number that really suggested that perhaps the labor market was much cooler than expected. And that drove expectations for rate cut expectations from 75 basis points for the rest of this year all the way to 125 basis points, thinking that the Fed was going to have to react much quicker to what is a deteriorating economic picture. You know, fast forward 2 weeks later, you had jobless claims numbers that have come out that have been relatively stable, that has showed that perhaps that job number was a little bit of an overreaction here. You have retail sales numbers that were surprised to the upside that really showed that consumers perhaps were still more spending a lot faster or a lot more resilient than a lot of investors were concerned about with regard to a recession. So the fact that, you know, it was really, I would say, on the back of kind of stronger economic numbers that offset the concerns around a recession that gave us the confidence to get us back to these all-time highs. But like I said in my previous note, you know, the market internals on this rally here back to all-time highs hasn't been particularly strong. The fact that technology led this market higher, but the major 7 technology stocks have largely been behind on this. Look at Microsoft, look at Nvidia, look at the semiconductors. They haven't particularly been anywhere near those all-time highs. And those are some of the concerns that I have with the equity markets right now.
Thank you for that insight, Tony. So I do understand there are 2 trade ideas that you wanted to share with us today. So let's get started. So there's always an opportunity available to us in the market. What's that first trade you're looking at today?
Yeah, the first stock that I want to take a look at is PayPal. And PayPal has been in a multi-year, call it a turnaround story. But recently, if you look at the stock, you know, it's been in a consolidation range for the last 2 years or so. And we've started to break out above that consolidation range. And I think we've just signaled a new bullish trend. We have actually highlighted on this show a couple of times back in April and back in June, opportunities to take a long position here in PayPal on this turnaround story. And just earlier this week, we managed to break out above that resistance level, which is a new bullish signal, which is why we're starting to take a look at this stock again, because it marks a pretty significant milestone in this multi-year turnaround story in PayPal after it's been spun out of eBay. If you look at the stock here, over the last 2 years, it's been range bound between 50 and 68 or so, and we just broke out above that level here earlier this week, and you have positive momentum on that breakout, which starts to target in the low 90s here to the upside. So this really is, you know, the start of what could be a pretty significant bearish to bullish turnaround for PayPal. And then if you look at the business, you know, this is really something that we've been speaking to for months and months on end. Just the fact that the valuations for PayPal continue to look incredibly attractive here. You're trading at about 15 times forward earnings, which if you compare that to the S&P 500, you know, that's about a 20 to 25% discount to the average S&P 500 stock. Yet when you look at the growth expectations for PayPal, they're expected to grow EPS at about 14%, revenues at about 8%. You know, those are numbers that are significantly higher than the average S&P 500 stock, and margins are quite strong at 14% net margins. So when you think about the fact that it's just as profitable as the average S&P 500 stock, it's growing faster than the average S&P 500 stock, yet it trades at a 25% discount. That's really where the valuations look also compelling given the, you know, where we're currently trading right now. So this is really an example where the charts show us that investors are starting to pay attention to PayPal and starting to outperform the markets. And you have a valuation that looks compelling. These are the opportunities that I like to look at when you see these kind of turnaround stories and you're trying to catch a trend very early on. And we've already started to take on these positions back in, like I said, April and June, and now is a fresh signal to get back into PayPal at the moment on this breakout. So the trade structure that I want to use is a trade that we just learned about in the previous session with Ed, which is selling a cash secured put here on PayPal, because it gives you the potential to acquire these shares at a discount if PayPal it trades below the strike price at expiration. So I'm going out to the September expiration and I'm selling the $71 puts. Earlier today, you can collect about $1.58 for those put options, which if gives you the obligation to buy PayPal stock if it's below $71 on the September expiration. This carries a total risk of around $6,900 per contract on this specific strategy, because you're effectively buying 100 shares of PayPal at around $69.50 if these puts are put to you. And obviously the risk is of if you own the stock and the stock goes to zero, that's the total risk that you have. In this particular case, if it does get put to you, you're going to own that stock, like I said, around $69.50, which is about a 2% discount from the potential stock purchase of that $71 strike. And that would allow you to effectively acquire the stock very close to the breakout level, around $68, $69 of that major resistance level that we were talking about for the last 2 years. The stock has struggled to get back above that level. Now it's broken out to the upside. If it does pull back here, you have the potential to acquire these shares near that breakout level. And that's exactly what we're trying to do here with this cash secured put.
Tony, how would you manage your cash secured put over the course of the month? And perhaps maybe even, is there a situation where you would consider closing the position early before expiration?
Yeah, that's a great question. Generally speaking, a cash secured put is a strategy that you don't really have to do a lot of management effectively, because what you're doing is you're setting aside cash to potentially acquire the shares, and you're typically doing this only because you're comfortable with the specific price that you're going to acquire those shares. So you typically hold these to expiration, and they either expire worthless or you end up owning the shares. But I do think that there are two scenarios where you could potentially exit this trade earlier. And that's if, number one, if PayPal simply takes off substantially from where it is here right now, and you effectively want to chase the stock, meaning let's say the stock rallies all the way up to 75 or 78, and obviously a $71 strike price is unlikely to get put to you or to be assigned to you at that specific price, but you want to own the stock because you think the upside potential is significantly above where it is right now. That's when you might want to close out, meaning buy back the $71 puts that you've sold. At that point, you would be able to make a nice profit on the puts that you've sold, and then simply sell a new cash secured put at a higher strike price, effectively recentering the cash secured put at a more reasonable price based on the current price at that time. That's one scenario where you could potentially exit a trade early if the stock simply takes off. The second scenario is if, let's say, some new information comes out and perhaps the stock declines substantially, or if some news comes out and simply you no longer take a bullish thesis on this particular stock. Maybe they provide some guidance that makes you rethink the upside potential here of the stock. Whatever the news that could be that affects your bullish thesis on this particular stock, that would be another reason when you might want to consider closing out this trade early, because you maybe no longer want to acquire these shares. So those are two scenarios where, generally speaking, you could potentially exit this trade early, but for the most part, these are the types of trades that you generally can hold to expiration.
That's really helpful, Tony. Thank you. So let's talk about your second trade. What are you considering today?
Yeah, the second trade I want to take a look at here reflects kind of the concerns that we still continue to see with consumer spending. I know the consumer spending, retail sales numbers last week came out far better than expected, and there were expectations that consumers' spending were still incredibly strong here. But if you look at the economic picture here with regards to credit card delinquencies, you look at surveys with regards to how much discretionary spending people are putting off here, especially in non-essential categories, there really seems to be a concern around how strong consumer spending will likely be going forward. And one particular retailer that I think is facing some challenges here is Best Buy, especially if you look at the discretionary spending that's moderating around kind of the category that Best Buy predominantly serves. And the 11 consecutive quarters of revenue decline that Best Buy has been experiencing really speaks to a business that's struggling a bit. So if we look at the stock, a chart here of Best Buy, recently on earnings, it did gap higher here. But since that gap higher, the stock has continued to deteriorate in terms of that trend. what you see is a series of lower highs and lower lows. And in conjunction with that, it's underperforming the S&P 500 as it kind of trades in this downward channel. So this is typically a bad signal going into earnings, and Best Buy is reporting next week earnings announcements at the end of next week. So, and if you look at the business here, this is really where I think that it's a little confusing because it trades at a valuation that seems quite cheap. It's trading at 14 times forward earnings, which is about a 30% discount to the average S&P 500 stock. But when you look at the actual fundamentals here, that's really where the fact that it trades at such a discount makes a lot of sense. Number one, it's not expected to grow particularly fast. It's supposed to grow roughly in line with the average S&P 500 stock. But when you look at profitability, this is really where the picture worsens substantially. The net margins here are only 2%, meaning this is a company that is barely hanging on to profitability. And when you consider the fact that over the last 11 quarters, revenue has continued to decline over the last 11 quarters, that is not a good picture of that is not a picture of great financial health of a company that's effectively losing market share and barely hanging on to profitability and continuing to have to cut costs just to stay profitable. So when you have a binary event such as earnings coming up next week, this is really where I'd like to turn to options to be able to take some bearish exposure on Best Buy going into that earnings announcement. So I'm going out to the September expiration and I'm selling and I'm buying the 86.77 put vertical. What I'm doing here is I'm buying the $86 put here, and at the same time I'm going to sell a 77 put against that. But this way, what it's going to do is reduce the overall cost of buying that $86 put, which going into an earnings announcement, options tend to be expensive. This is a way to kind of reduce the overall cost and overall risk on the trade. Earlier today, you can buy a put vertical on Best Buy for about $3.10, which gives me the potential to make up to $590 per contract if Best Buy is below $77 at expiration. And in total risk, I'm only risking $310, and that's if Best Buy is above $86 at expiration. So this is really taking a bearish view going into the earnings announcement next week by taking a look at the overall chart, the fact that investors are seemingly selling the stock faster than they are other stocks in the S&P 500, and looking at the financial picture that clearly looks like a business that's struggling a little bit.
Thank you, Tony, for that trade. Thank you, Tony, for that trade idea. You know, you talked about max risk and reward. And of course, these are based on figures held until expiration. I'm going to ask you the similar question as I did last time, because I think our viewers find it really helpful to know, you know, how do you manage the trade like this? So is there a scenario where you would decide, hey, I want to close this position prior to expiration? And if so, what are the triggers that would make you do that?
Yeah, that's a fantastic question. So in the previous example, when we're talking about selling a option such as in a cash secured put, generally speaking, when you're selling an option, you have the option of holding these trades till expiration. And many times you might do that as they perhaps expire worthless. But in this particular case, the main strategy driver of a put vertical spread like this is you're buying an option. Here we're buying that $86 put. That's the primary driver of the strategy. And when you're buying an option, generally speaking, the rule of thumb here is that you do want to close out these trades prior to expiration. You generally don't want to hold these to expiration. So the rule of thumb here, specifically, especially with earnings coming up with a binary event, is that the binary event, generally speaking, is the trigger to determine whether or not it's time to take profits or cut losses on this specific trade. The rule of thumb that we generally have is that if you lose more than 50% of the premium that you pay on a option contract like this, then chances are the thesis that you have, meaning the bearish thesis that I have on Best Buy, is not working out. And it's certainly unlikely to work out in the time frame that I have set forth on this particular trade, which is the September expiration. So if I'm paying $310 per contract for this specific trade, and let's say that contract is worth half as much after the earnings announcement next week, roughly $1.50, $1.55, that's probably a good sign that it's probably time to cut my losses and move on to the next trade. And on the flip side, if this trade does move in the direction that I expect it to, the rule of thumb is that if it gets close to that lower strike, which is the $77 price on, if earnings comes out and Best Buy declines on earnings and it gets close to that lower strike of $77, that's also a good time to consider taking profits on this specific trade. So those are rules. Those are some of the rules that I typically have in place for placing these types of debit vertical spreads going into an earnings announcement and when I might want to consider closing out those trades.
That's very helpful. Thank you, Tony. So we do always save time in our conversations to look back at some of the past trade ideas and see how they played out. So I understand we're looking back today at gold.
Yeah, that's right. A few weeks ago, I laid out a bullish thesis here on gold, and since then, gold has broken out to new all-time highs. So back then, what we did is we sold the September 6th 227.5, 220 put vertical here. What we're doing is that we're effectively selling that 227.5 put, similar to the cash secured put we're selling with PayPal. But what we're doing is instead of just selling a single put, what we're doing is we're also buying a 220 put in addition to that. What that did is that reduced the amount of overall risk that we took on the trade, and it also reduced the amount of margin requirement required to get into a short contract on gold, which is trading at a much higher price than PayPal was. So at the time we sold that vertical spread for about $3. Right now we're trading just a little under that, about $1.56 or so. So what we're doing is we're going to buy that back for about $1.56 and close out this particular trade because it did trigger both our take profit and our days to expiration rule. Both of them have been triggered. So this is why we're closing out this trade for profit.
Thank you for that reflection. We just talked about one of your previous rules. Can you talk more about your max profit rule as well as days until expiration rules? Can you kind of lay those out for us?
Yeah, absolutely. So this is what we call a credit vertical spread. And credit vertical spreads on the surface may seem a little bit more complicated because generally there are 3 triggers to potentially close out a trade prior to expiration. There is a take profit rule, there is a stop loss rule, and there is a time-based rule. So let's first go through the take profit rule, which is if you collect more than 50% of the total max gain on a credit spread, those are opportunities to start taking profits on the trade. And that is what was triggered here in our example, in today's example for this put vertical spread. Now, on the stop loss side, if you lose 100% of the total premium that you've collected, those are opportunities to simply cut your losses and move on and not let the losses necessarily expand beyond that. Even though these strategies have limited risk, you don't generally want to hold these until you have the maximum loss potential on these trades. You want to typically cut that loss prior to that. But there's a third rule here with selling a credit spread, which is you generally want to start managing these trades about 2 to 3 weeks out from expiration. We're about 17 days from expiration, so we're just inside that range of 2 to 3 weeks. And the reason for this particular rule is because as you're selling an option, one of the things that works in your favor is time decay. As you get closer and closer to expiration, time decay works in your favor faster and faster. However, that acceleration in time decay also has an unintended effect of taking on higher gamma risk. So for those of you that do have studied some of the option Greeks, theta is working faster and faster in your favor as you approach expiration, but gamma risk is also starting to accelerate as you get closer and closer to expiration. And that crossover between where the time decay is working in your favor versus the risk is starting to work against you, that crossover tends to happen around that 2 to 3 week mark, which is why we have a rule to simply look at managing these trades 2 to 3 weeks out from expiration. You don't have to close it out necessarily. You can basically roll it out to a new 45-day contract, as you approach that 2 to 3 week rule. So for example, if let's say you still maintain a bullish view here on gold, you don't have to just close out the trade like I'm doing here. You can simply close it out and then sell a new credit spread, buying yourself another 45 days worth of time, collecting more premium, and continue to do that until you no longer have a bullish thesis here on gold. But that's why we're managing this trade here today.
That is really informative. Thank you so much, Tony. So before we wrap up today's trade part of our conversation, Tony, can you give us an idea of what's on the agenda for next week's episode on In the Money?
Yeah, every week we're here to talk about the markets, but next week, with earnings seasons wrapped up, our focus really turns to economic data. You have GDP that comes out and the PCE, which is the Fed's preferred inflation gauge. We'll also review how Jackson Hole has been shaping up here by next week's show. So a lot to discover here on the economic front, especially as we're at these pivotal levels with the equity markets at all-time highs.
That's excellent. Looking forward to that, Tony. And this brings the first part of our presentation to a close today. During the second part of our hour, we'll be answering customer questions, so please stay tuned. And if you're interested in further details specific to Tony's trade ideas that he shared with us here today, please join our midday market briefing, which will be held tomorrow. And you can do that by visiting fidelity.com/in-the-money-follow-up. Now, as we shift gears, today we have the opportunity to take questions from our viewers, which is really exciting. So, Tony, if you're ready, let's jump right in.
This is my favorite part, Roberta.
I'm pretty excited about it myself. So, let's start with kind of general questions about how do we get educated? What are the tools and resources available to us as investors? My first question comes from Callie Ann, and Francis has a similar question, so I'll ask them both sort of together. Do you have a recommendation on the best book on options trading? And Francis more specifically wants to know, are there any books or courses you'd recommend for a beginner?
Yeah, absolutely. I think there's a couple of books that I would generally recommend, and also just general resources to help you get acquainted with options trading. On the book side, there's a fantastic book. It's been one of the best-selling options book for 15 plus years. By a good friend of mine, Brian Overby. It's called the OptionsPlay book. It's been seen multiple versions here. You can buy both a paperback and a Kindle version, depending on what you prefer. Great book that will cover kind of all the major strategies that you could potentially trade, what the risk and reward, how to construct them, kind of understanding the risks and rewards of each one. Really incredible book for investors to get a good broad range of the different options strategies that you can trade, in addition to the two that you learned during today's session. The second book that I think is really useful is, some of you might know that I was on a show on CNBC called Options Action for many years with Michael Coe, my co-host. He wrote a book called The Options Edge. So for those of you that are looking for a little bit more in-depth understanding of how option markets work, how option pricing works, and how, generally speaking, you can find opportunities in the markets utilizing options, that's a fantastic book as well. And then beyond that, I think that some of the best learning that I tend to find is really hands-on learning. And that's really what I think Fidelity excels at, with these fantastic education sessions that you guys put on here at Fidelity that give you, really in-depth and very broad range of options knowledge here. The webinars that you guys host here is a fantastic resource to be able to not only understand conceptually option concepts, but more importantly, showing you how the tools that are available to you here at Fidelity to be able to actually implement the concepts that you learned here. Those two, I think, are incredibly important for most investors to really grasp these option strategies and be able to implement them in your portfolios.
Thank you, Tony. And if I could add a little bit on to Francis's question, which are there any courses? Well, going back to the resource that you mentioned here at Fidelity Investments, we have a learning center, and there's a lot of self-study you can do, whether it's webinars or just content that you can read through, and you can choose what level you're on, whether you're advanced at your options trading stage or a beginner. So there's a lot you can use as a resource right here on the fidelity.com website. So thank you for that information. Our next question comes from Sanjeev, and he says, besides option chains, what other tools does Fidelity offer which can be used to make buy-sell decisions? And then I'll add, Charles has a question here too that says, what are the best Fidelity tools for options trading?
That's a fantastic question. There's a lot of tools that you have available to you here at Fidelity for options trading, both in terms of for idea generation, which I think was one of the first questions, option screeners that help you identify an option strategy, builders that help you build out an option strategy based on a specific outlook that you may have for a specific underlying security. There are screeners here at Fidelity that you can run both on technical and fundamentals to screen for bullish or bearish stocks that account for not just the technicals and fundamentals. I like to really take an approach where I look at both. I don't love only looking at technicals or only looking at fundamentals, because I think you're always missing some part of the picture if you're only doing that. So the fact that the screener accounts for both, I think, is an incredibly powerful tool. And lastly, I'll do a bit of a shameless plug here, but OptionsPlay, I'm one of the co-founders of OptionsPlay. We have a fantastic integration with Fidelity where we've taken a lot of the work that investors typically have to do to go through a list of securities and find an option strategy on each one to figure out which one's the trade. We have a fantastic integration with Fidelity that basically automates all of that work for you. And you can find that on your Fidelity platform with option strategies and income strategies and trading strategies directly integrated to your Fidelity account. This way you can find cover call, short put opportunities immediately on the stocks that you're holding and the stocks that are in your watch list.
Yeah, pretty thorough cover there, Tony. And I'll also add from what the sessions that you, if any of the viewers have been staying with us all day long, you've gotten a demo of some of those tools and evaluation tools and resources that are available. What you might have also learned in those sessions, that Fidelity also has a trading desk where you can receive coaching as well as strategies. So lots of resources available when you're thinking about how do I go about doing my next option trade. We'll move on to the next question, which comes from Ismail. He wants to know, what are the 3 most valuable resources for a new trader to know or have available to them?
That's a fantastic question. I think that question can go many, many ways, but I actually think that we covered a lot of these things in terms of Ishmael, your question. Number one, education. Education and tools are by far the most important things that you can get yourself acquainted with. I do think that a lot of traders, what they tend to do is they want to jump right into the strategies, jump right into trading them and kind of figure things out as you go along. But options is really one of those things where you really need to start from the foundations and build that strong foundation before you can dive into some of the more complex strategies and the strategies that you really want to trade. So a good example of this is that, even though there are 4 core strategies, long call, long put, short call, and short put, out of all of those 4 strategies, you may not necessarily actually use those 4 strategies very often in your trading. You actually might use 2 of them quite often, but the other 2 you don't use very often because it's better to use some more advanced strategies. But before you can jump into those advanced strategies, you really have to have a good foundation. So this is really where I think that a lot of investors kind of skip past it or try to get through the foundation as quickly as possible to get to what they really want to do, which is trading some of the more sexier, complex strategies that give you the true risk reward that you're looking for. But without that foundational knowledge, you might find trading those strategies to be complex, and you might find that some of the risks involved you don't fully understand. So I do encourage investors that if you're starting out, make sure that you take the time to understand the foundational knowledge. And there's an incredible amount of resources here at Fidelity to help you learn that foundational knowledge, but at the same time, for you to build on that and start taking kind of more advanced strategies as you go along. But the education, the tools here at Fidelity are top-notch with regards to helping you build that foundational knowledge so that you can move on to their more advanced strategies.
Tony, I really like that answer because you're leading us to Deep, who has a question, and I think you've sort of given us some of best practices and tips for novice traders. And so that's his question. Do you have any other ideas that you'd like to share, for someone that's getting started? What kind of tips should they be aware of, and what best practices should they employ?
Yeah, absolutely. I tend to find that a lot of beginners will ask me a very similar question, which is how much money can I make trading options? And I always tell investors, you're asking the wrong question, because there's no limit as to how much money you can make on options, but there is a limit as to how much money you have to risk in order to trade options. So the number one thing that I always tell investors to pay attention to first before you look at anything is risk. understanding what you're risking with each individual trade, making sure that you have a good process and plan for deciding how much you are willing to risk per trade. Because generally speaking, if you think about how a professional manages a portfolio, what they really, the only rule that they generally have with a portfolio is they're never allowed to exceed a certain amount of their overall portfolio in terms of risk on a single trade. For example, if let's say you were trading for a hedge fund or any type of proprietary firm where your job was to trade options all day, that's the only rule that generally speaking you have put in place. Yet that's the one rule that most retail investors don't have for themselves, because you're not going to get fired if you exceed those rules. But if you're trading professionally and you exceed your risk management plan, you're going to get fired, which is why you're always going to stick to that. And that's what's the primary difference between professional traders and retail traders. So if you're thinking about learning how to trade options, or if you're trading options today and you don't have a risk management plan in place, I encourage investors to stop trading new option positions until you put that in place. For example, a good rule of thumb is that no single options trade should risk more than 2% of your total account value on any given trade. What that means is that if any trade that you place, the maximum loss of that trade exceeds more than 2% of your total portfolio value, you might be taking on too much risk per trade. And what that means is that you have a higher probability of having a pretty significant drawdown in your portfolio at some time throughout the year. Might not be this week, might not be next month, but at some time throughout the year, if you're risking typically more than 2% of your account per trade on each trade, you will likely at some point this year suffer through a pretty significant drawdown that's going to be difficult to get yourself back from. And that's really what I see in my 17 years of being a market strategist, working with thousands of retail and institutional traders. That's the one thing that generally brings down most investors, is not having a solid risk plan before they start trading.
Thank you, Tony. So Shane, I want to ask his question because he's got the $1 million question all of us always want to know. Do you have any advice on how to maximize profit when you're selling calls and puts?
That's a great question. So let's cover calls and puts separately. During today's session, you learn about both cover calls and cash secured puts. And both of these strategies, we have done an incredible amount of back testing and research into what are the optimal call it parameters for generating the maximum expected outcome for these strategies. And what's surprising is that for both of these strategies, they're quite different from each other. Now, if you think about a cover call, you're selling call options against stock that you own when you sell a cover call. And the income that you collect on a cover call is actually fairly small relative to the total risk that you take on by owning that stock. Meaning, let's say you own 100 shares of Apple at $200, you sell a call option on Apple, you might make a few $100s in income, but you have $20,000 worth of risk that you're taking on with your equity position. So a few $100s in income really doesn't weigh very much versus the $20,000 worth of risk that you're taking with the underlying stock itself. So always prioritize capital appreciation of the stock that you own over the amount of income that you collect on the cover call. So a rule of thumb that we have with selling cover calls is select strike prices that are almost absurdly far away from the current price of the stock. We usually use a delta-based approach to select our strike prices. What we're doing is we're using usually about a 10 to 15 delta cover call to sell. And what that means is you're taking a strike price that has only about a 10 to 15% chance the stock is going to get called away. So these are strike prices that are pretty far away from the current price of the stock. And what that allows you to do is to have as much capital appreciation as possible on the underlying security that you own, because that's really where the overall risk that you're taking is going to be. So you should prioritize capital appreciation of your stock over the amount of income that you collect on that cover call. And if you do that, you're going to see better outcomes in the long run. On the flip side, when you're selling a cash secured put, it's sort of the exact opposite. You want to have a higher probability of owning that stock, because when you're selling a cash secured put, the reason that you're doing it is because you're taking on the obligation to own that stock. You generally want to sell cash secured puts that are relatively close to the current price of the stock. And that's going to give you two effects. Number one, it's going to give you a higher probability of owning that underlying stock, Number two, it's going to give you a much larger discount amount because selling an at-the-money call, a put option or a put option that's very close to the current price of the stock will generate as much income as possible. And that income amount goes towards the discount factor that you have when you actually acquire those shares. So that's kind of the general rule of thumb that we have with maximizing the expected outcome for cover calls and cash secured puts.
All right. Shane, you got the secret right there. All right. So Serum, he wants to know, can you explain the bid and the ask? He has three that we want to know about. Open interest and IV, implied volatility. And when you're thinking about these three things, what are good values before choosing to own or sell that option?
Fantastic question. So the first two are sort of related to each other, open interest and bid ask, because both of those give you a better sense for liquidity. And arguably the bid ask spread gives you a far better view on how liquid an option is than open interest. If you're going to look at open interest across the entire chain. Don't look at open interest on a single strike, because many times an option might, excuse me, many times an option might have hundreds and sometimes even thousands of strike prices. So, just looking at the strike price of an individual strike price doesn't give you a good picture at all. But if you look at the entire options chain, how much open interest is there across the entire chain, you usually will get a pretty good sense for how liquid an option is. Generally speaking, open interest of greater than a few thousand contracts is the bare minimum that you're looking for. But I still think that the best gauge of liquidity is the size of the bid-ask spread. How tight are the bid and ask quotes? The more competitive, the more liquid something is, the tighter the bid-ask spreads. If you look at the most liquid names like SPY, across the board, bid-ask spreads are about a penny to 2 pennies wide for the most part on all SPY options. Those are the most liquid options that you can potentially trade. But most single stock names, even the most liquid ones, will trade somewhere between 5 cents and 10 cents wide in terms of bid-ask. That's usually considered a very liquid underlying name. And then you start getting into 20, 30, 40 cents. Those are some of the somewhat liquid names. And anything beyond 30, 40 cents in terms of bid-ask quotes, chances are it's not a very liquid underlying. So, the bid-ask quote is usually a pretty good gauge for whether something's liquid or not. And that gives you a good sense for whether you're going to get filled at the midpoint or very close to the midpoint, or you're going to have to fill something much closer to the natural price, which is the bid-ask price. And then the third component, I think, was implied volatility. So every option price is comprised of two components. You have your intrinsic value, which is what the option can be exercised for today in terms of potential, how much the option is in the money by, the name of the show. And then whatever is left in terms of the option premium is called extrinsic value. And extrinsic value is comprised of two components: time value, how much time is left between now and expiration, and implied volatility. Implied volatility is simply the market's future expected volatility of that underlying stock. So the more volatile the stock is, the more the higher the expected future volatility of that stock is going to be. And that's going to translate to a more expensive options price. The less the market expects that future volatility is going to be, the cheaper that option price is going to be. So implied volatility basically is giving us a read into how volatile does the market feel the future of that specific asset is going to be. And the most famous implied volatility metric is going to be the VIX. The VIX is approximation of the 30-day future expected volatility of the S&P 500. So if you have a VIX reading of 20%, that means the annualized expected volatility of the S&P 500 going out the next 30 days is 20%. So the VIX is probably the most famous reading of implied volatility, and it's usually used as kind of, as many people call it, the fear index. The higher that VIX is, the more fearful people are of where the asset is going to be sometime in the future. The smaller the VIX is, the less volatile, the less fearful we are. So that's kind of a way that you can think about implied volatility.
That's helpful. What a great question from Serum. Next, let's go with Steve's question. He just wanted to know, and if you could just broadly talk about the the power of options versus buying stocks or the underlying security directly. What's that leverage power?
Yeah, it's not just leverage that I think that attracts a lot of investors to options, even though that is a pretty significant component of it. But I really think it's the asymmetrical risk that gets a lot of people interested in options to begin with. So for example, if you look at buying a call option, you're effectively controlling 100 shares of an underlying security for a fraction of the cost of buying 100 shares of the underlying stock. That's the leverage that you're referring to. But we usually think of leverage as a double-edged sword, right? If the trade goes in your favor, yes, you've leveraged up your capital and you're making a really nice return on your investment. But if the trade goes against you, you're going to lose a significant portion of your investment, or maybe lose substantially more money than you originally intended on. So if you're typically trading equities on margin, you're taking on potentially more risk than you might have, or it's just simply a double-edged sword on both sides. So with options, what you have is kind of consider it the best of both worlds, even though it's more nuanced than that, is the fact that if you get the directional view correct, you've got leverage to the upside. So for example, if you buy a call option on a stock that's trading at $100, let's say it only cost you $10 to buy that option. So you're basically leveraging your capital about 10 to 1. And if the trade goes in your favor, you effectively are controlling 100 shares of that stock. Instead of paying $100 a share, you're only paying $10 a share, but you collect the upside as if you own 100 shares of that stock. But to the downside, you have limited risk. What you pay for an option is the most you can lose, no matter what happens. Even if the stock drops 50% over the expiration of the option, you are only risking $10 or roughly 10% of the stock's value. So that asymmetrical risk is actually what I think brings a lot of investors to trading options. But like I said, it's a little bit more nuanced than that. So I think it's important for investors to understand kind of what are the trade-offs with that asymmetrical risk before you jump right into trading call and long calls and long puts, which is why I said before, about how important it is to build that foundational knowledge. A lot of people look at kind of that asymmetrical risk of a long call and put and say, great, let me trade that because I can leverage my capital to the upside if I'm right. I'm limiting my losses to the downside without truly understanding what are the trade-offs with that. And once you understand the trade-offs with that, you tend to want to trade more complex strategies like the one that I did with Best Buy, trading a vertical spread, which gives you a little bit of the best of both worlds where you can get some upside leverage, but even further control your downside risk and offset some of the nuances, like I said, the additional risk that you're taking on when you have this asymmetrical risk profile.
I want to go to James's question because I think it runs alongside, what you're describing. James asks, can you discuss the benefits and the process to using SLs, also known as synthetic longs?
What are some of the benefits of using synthetic longs? To be perfectly honest, if you think about put call parity of options, right, you don't have any potential benefits of using meaning a synthetic long is an equivalent of being long the stock. Now, you may have some benefits from a margin perspective, right, where you could potentially be long the stock at a fraction of the capital that it would require to be buying 100 shares of the stock, or even if you're doing it on margin, which means that you're simply doing it for capital efficiency or you're doing it for leverage purposes. That is the only potential advantage that I would say that you have, because the other thing about synthetic longs is that you don't capture any dividends, which is a downside here to being long synthetically rather than being long the underlying. So but overall, the difference between the two are not as big, I think, as investors might think it is. Largely, the two are meant to be very close to each other.
Thank you. So I've got a question from Mark. It's around how to create cash flow using options. And Lee Quang is also asking a similar question and wants to know what are some good income generating option strategies. So perhaps answering both of those together, Tony.
Yeah, first and foremost, it's the two strategies you learned in the previous session: cover calls and cash secured puts. Cover calls by far the #1 options income generating strategy by retail investors. There's a good reason for that, because by selling a covered call, you're not taking on any additional risk in your portfolio. You're just giving away some upside of the underlying stock portfolio that you have in exchange for some upside income. That is by far where everyone should start. If you're just starting out with options, start with selling covered calls. You own a portfolio. If you have a long-term portfolio with stocks and ETFs in there, those are assets that you can immediately use to sell calls against and start generating that cash flow every single month, potentially for selling selling covered calls. And then the number one most underutilized option income strategy is cash secured puts. I don't know if you in the previous session where you think about this, but cash secured puts is a way to acquire stocks at a slight discount than what the current market is offering right now. And cover calls basically allow you to extract income on the equity investments that you have until it reaches a certain price where you can potentially take profits on that underlying security at a higher price sometime in the future. But it's the combination of the two that we call the wheel strategy, because you want to acquire shares at a discount and then earn income on it and eventually sell it off at a profit and then take the proceeds and buy the next stock that you want to do. And that circle, if you will, is called the wheel strategy. So those are by far the two most important income generating strategies from an options perspective that you can have in your portfolio. And once you have a grasp on that, you can then graduate to more complex strategies like selling credit spreads, maybe even selling iron condors or selling straddles. But it requires you to have that basic foundational knowledge from selling cover calls and cash secured puts before you can move on to those more complex strategies.
Well, our next strategy question comes from both Raymond and John, who are interested in diagonal spreads and just want to understand, if you can discuss how they work and when would you use them?
Great question. We're really diving into the deep end of the pool here with time spreads. So diagonal spreads are a type of time spread where you're effectively buying a longer dated option and selling a shorter dated option against it. Generally speaking, these are more neutral strategies, meaning you have a neutral view on an underlying security, but you actually expect implied volatility to come in. So this is not only taking a directional view, but it's also taking a view on future expected volatility. And this is something that's common for more advanced traders. They look at kind of implied volatility. The one thing about implied volatility is that it's mean reverting, meaning it tends to trade around an average. So when it gets significantly above the average, traders will typically bet that implied volatility will come in. And then also if implied volatility is well below average, people will bet that implied volatility will rise. So a diagonal spread or rather a time spread is a way to potentially trade a short volatility play, meaning volatility is high, you think it's going to come back to the average, and then at the same time with a put diagonal spread, you can take, generally speaking, a slightly bearish tilt to that trade. So a time spread you can trade as a calendar spread, which is purely neutral. You can trade it as a put diagonal, which is slightly bearish, or you can trade it as a call diagonal, which is slightly bullish. But overall, your view is that you expect implied volatility to come in, and it just depends on whether you also have a bullish, bearish, or neutral tilt to that view as well.
Thank you for that, Tony. So I think I have two questions in that are similar. Gregory asks, how can you use leaps as portfolio insurance? And then I have another question from Mayhan, who's asking, how do you hedge a long-term portfolio?
Great question. Was the first question, can you use a leap for income? Is that what the question was?
How could you?
How to. Right. So I would say that, if you think about using leaps, which are longer dated call options as a portfolio protection, you can think of a call option as a synthetic long stock and a long put, right? Which kind of ties into the second question, which is how do you hedge a portfolio? Now, generally speaking, if you think about a long call as the synthetic long stock and long put, what you're really trying to do is select a strike price where you feel you want to have some protection below that specific strike price. So for example, if a stock is trading at $100 and you buy, let's say, an $85 leap on that specific stock, you're effectively trying to reduce your downside risk below that $85, right? So you're selecting your strike price based on where you want protection below that specific price. So it's actually one of the simplest trades that you can make to protect your portfolio against some downside risk. Now you have to pay for that downside protection, but it's one of the ways that you can do so. And then the secondary question, which is how do you hedge a portfolio, which is effectively you're long the stock and you want to buy a put option to protect your portfolio. Well, synthetically speaking, it's actually the exact same risk profile as simply buying a stock. So if let's say you own the stock at 100 and you buy a put option at 85, you have the same risk profile as someone who just bought the $85 leap. So those two, from a put call parity perspective, will be priced the same, right? So owning 100 shares of the stock and buying a put option will have the same cost, if you will, as being a long call at the $85 strike. So this is also starting to get into some of the theoretical parts of the options. Like you really have to understand option pricing to fully understand what I'm trying to say, but just understand that buying an $85 call option is synthetically the same thing as being long the stock and buying an $85 put. Both strategies will protect your portfolio below that $85 strike price. But like I said, in both instances, you have to pay for that protection. And you might want to consider how much you have to pay. And you might realize that most of the time, it's not worth paying that much because portfolio insurance in the form of a put option is very expensive.
Thank you. Let's go to Dory's question, and she wants to know just what are some strategies you can use to take advantage of volatility?
So this is also starting to get into the deeper end of the pool. There are many strategies that you can use to trade implied volatility. Probably the simplest strategies are trading a debit or a credit spread. Now, those give you, I would say, modest exposure to changes in implied volatility. And they also come with other exposures as well. You're getting a fair amount of exposure to the underlying security movement. You're also getting a fair amount of exposure to time decay. So a more pure strategy to trade changes in implied volatility typically are butterflies, straddles, and strangles. But again, those are kind of more complex strategies, but those give you a far more clean exposure to implied volatility without the directional exposure as much directional exposure and without as much time decay exposure in conjunction with that. So this is really where learning the option Greeks help you understand what you're exposed to with each underlying option strategy so that you understand not only am I getting exposure to the view that I have, but are there any additional risks that I might be taking on that I'm either not aware of or need to be aware of? So the option Greeks is really what translates to us how much risk we're taking across the board with these other external factors for an option strategy.
Thank you, Tony, for that. I realize we are already coming up on the hour, so I'm going to ask one last question, and this one comes from Robert. Do you have any advice on how not to sell winners too soon and not hold on to losers for too long?
That's a really great question, Robert, and I think it's a great way to wrap up this session. So first of all, I think the best thing to do is to have a trading plan, and the short answer to your question is that there isn't an easy way to go about doing that. Arguably, that's probably the hardest lesson that professional traders have to learn is how to stick with their trading plan. Meaning, it is human nature to want to take profits early and let our losers go on for too long. And it comes down to the fact that as humans, we don't want to accept pain. And in both instances, what we're doing is we're trying to avoid pain. When we don't cut our losers when we should, what we're basically saying is we don't want to crystallize a loss because it's too painful to sit through that. And what we do is we end up just holding on to trades for longer than we should. And that's just a muscle that you have to exercise like any other muscle, that you have to just get into the habit of when you say you're going to cut a loss, go about doing so and doing it ruthlessly. And on the flip side, why do we take profits too early? We do it because we're too afraid of what happens in this small winning trade that we have turns back into a loser and we don't take profits on it. That's even more painful when you have a winning trade that turns back into a loser. So what do? We take profits too early. And again, there's really no easy way to fix that. It's really just a muscle that you have to exercise to understand that as humans, we tend to do do counterintuitive things for our portfolio, and we have to recognize that, and we have to work towards building better behaviors. That's really the thing that I've learned in the 18 years of working with investors that is helping shape kind of traders to becoming better investors by flexing that muscle. But because there's no easy way around it, it's like there's no easy way to lose weight. You have to take the time to do the work and exercise those muscles.
Well said. And with that, congratulations, Tony. You are off the hot seat today. Thank you so much for this wonderful dialogue.
Thank you so much, Roberta. Thank you so much, everyone, for joining here this afternoon. This has been an incredibly fun session to walk you through what we're thinking of the market, some trade ideas to leave you with, and hopefully answering some of your questions today.
I agree. And what great questions and participation. Thank you so much to all of our viewers. This does bring us to a close for our show today. Again, thank you to our viewers for tuning in. And thank you, Tony, for bringing us your thoughts and trade ideas as always. I also want to say, if you're looking for further insights or if you missed the live show today, be sure to sign up for the Active Investor Weekly newsletter to receive highlights of the trades discussed. And you can also do that by visiting fidelity.com/Active Investor Weekly. Next week, we'll be back with you for another episode of In the Money. Take care.